we're good to go. So I've been told we're good.
Good to go. Okay, folks, time to get rolling. Before we start the meeting, let's go ahead and have our safety briefing. Tim?
Great. You're on the 9th floor of the Energy Plaza west side of the building. The restrooms are down at the end of this hall, to the left and to the right, men's to the right, women's to the left. In the event we have to exit this room, we would exit on the elevator all the way down to the main level, exit out on the 17th Street side of the building, unless there's a fire, and we would use the steps, and we would exit in the same manner, down the steps and out on the 17th Street side. If we need a secured area due to a storm, our security folks would escort us to probably the call center area, where it's also a secure area for storms or tornadoes. The AD and the first aid kit are just outside this door and to the right, one on top of each other. Is anybody here certified in the use of an AED or in CPR? So obviously we have quite a few people to be able to do that. That would be great. The fire extinguisher is right behind me, right here, in the event that we need it. And if you have a medical condition, please write it down or tell your neighbor. And are there any questions to the safety briefing? Seeing none, I'll turn it back over to you, Director.
Thank you. I probably should have read the opening statement first. This is an announcement regarding public notice of meeting. Notice of the time and place of these committee meetings was publicized by notifying the area news media, by updating the OPPD website, and by mailing such notice to each of the district's directors on November 7th, 2018. Our first committee report is Finance, and I'll turn it over to Mark or Craig.
Or Javier.
Well,
Javier, take it away.
sound like Mick doing that.
Good morning, everyone. It's with pleasure that I'm here presenting the October financial report. 10 months out of 12 of the year have lapsed, so things are now starting to shape up for the end of the year. And it's a pretty straightforward report for the month of October. On the retail revenues, we're pretty much flat for the month, just $800,000 under budget. So total retail revenues for October were $68.6 million. Off-system sale revenues were $16.3 million, which is $6.1 million over budget. And this is expected as in the shoulder months as wind starts to pick up. Our production on wind facilities starts to hit the market, and we are selling. We were all things considered, a net seller into the market for the month of October. Other income for October was $4.3 million, which is $1.6 million under budget. Pretty flat, really nothing outstanding to mention here. On O&M expenses, for October, we were at $31.9 million, which is $2.8 million over budget. The majority of that increase over budget on O&M is a reclassification of capital expenses that had occurred in previous years, that through accounting due diligence we realized that it was better to be reclassified as expense. So it's not an increase over our regular O&M expenses, it's a reclassification of capital to expense. That happens from time to time. The fuel and power purchase expense for October were $30.7 million, which is $5.6 million over budget. And this is, when you pair this up with the off-system sales revenues, this is where I was making the comment that we were a net seller into the market. We did buy power, but less than the power that we sold, at least compared to budget. Other expenses for October were $31.1 million, which are $3.2 million under budget. That brings us to our net income for October, which was a loss of $4.4 million. October, we were budgeting for October to be a loss anyway for net income. It was $4.4 million, which is $1.5 million worse than what we had expected. And it's a reflection of the accounting adjustments that I mentioned earlier. Again, not a big variation. I think it's something that it's expected. So let me just pause there for a minute. On net income, we're still expecting, so our year-to-date net income was $82 million. Our forecasted, our budgeted net income is $79.6 million. So we are ahead of the budgeted. I expect that in the month of November and December that will come back down, and we will likely end up the year with a net income result that is lower than what we had budgeted for. Still positive, still will give us enough flexibility to do a few things that I'm going to mention later on at in my presentation of the COP. It's a positive year still for OPPD. On capital expenditures for October were $9.1 million, which is $1.1 million under budget. Year to date, we are at $90.6 million of capital expenditures, which is $25.2 million under budget. We've had, again, a pretty busy summer and early fall with storms, which have delayed some of our capital projects. We're working with our capital planning teams to make sure that we execute our capital budget as close to budget as possible, but we are year-to-date $25 million under budget. The unrestricted cash balance at the end of October was $460.6 million, which is $63.4 million over budget. This is, if you remember, this is something that we've been carrying from 2016 to 2017 to 2018. It's really a reflection of good financial management. We are at $460.6 million, which is, it puts us at about 259 days cash on hand. It's still below what the median large public power entities have in terms of the days cash, but it's certainly going up closer to what the median is. These, if you remember, this is one of the things that allowed us to do the cash defeasance transaction we executed in August and allowed us to issue lower interest rate debt later on in September. So with that, I'll conclude the report. I'll entertain any questions.
Can you remind me the capital expenditures, what capital expenditure we avoided, I guess, or didn't do that was planned for September? There was that big planning expenditure.
For September,
Yeah,
you're looking at the graph?
yeah, I'm looking at the graph. In that upper graph.
I'm pretty sure it's not just one. I think it's a combination of many. Okay. So the red line is the budget. When we prepare the budget, what we do is we don't go specifically to talk to each project manager. What we do is we look to previous years. We do a 3-year rolling average, which in previous years we've had a pretty active September. So that's how we modeled the budget. Okay. It doesn't necessarily tie to a project. The underspend, not only for September, but for the remaining of the rest of the year, is a combination of a bunch of different projects. And it's not only just the ability for us to execute when we're actually putting steel on the ground, it's the ability for us to plan, design. There's a whole pipeline that is involved. And it's something that we're working on with all the different business units to try to get better at executing our capital budget. But it's not tied to a specific project.
Thank you.
You're welcome.
Javier, what was the nature of the $2.3 million in capital expenditures that got reclassified this month to expense?
I'll do a quick explanation, and I have a friend in the audience that can help me here. We're talking about the reclassification. We has to do with the unitization of assets. When we put those capital dollars into the Nebraska City Station, we the team unitized the expenditure at a pretty high level, and based on our accounting standards, in order for those investments to be classified as capital, we have to unitize them at a lower level of unit. That was not done at the time. The dollars were spent on capital, but following our capitalization policy, they were not unitized at the appropriate level. Therefore, it's driving us to expense them.
More or less a different overhead rate applied.
It's not necessarily the overhead. Do you want to? I brought Lorelei.
This is the phone a friend.
This is a phone a friend.
Yeah. Shout out.
Peter's mentioning with the unitization of those, they were reported at a higher dollar level, and to qualify as capital, as we do improvements later, they need to be considered a betterment, so you have to meet a certain threshold. So because they were unitized at a higher level, they don't qualify as a betterment at this point, so they're considered O&M. And that's something we're working with the production group on, going back and looking at those assets and seeing should we unitize those differently.
So, Laura, part of what we spent is still sitting there as capital. Is that a fair statement?
That's a fair statement.
Okay. I get it.
Thanks.
Just means there's, by policy, a limit what you can capitalize on those expenditures. So we were over that limit, we corrected it.
Right.
Thank you.
By the way, that was Laura Langford, our Director of Accounting Services at OPPD, by the way. That was the photo friend.
My friend.
Feel like I'm in cash cab.
Any other questions? Okay. Then we can move on to the next item on the agenda is the reporting of the retirement plan as of the third quarter of 2018. Remember, this is important to remind everyone, this report is as of the end of September, right? What I just previously reported was as of the end of October. It's a big difference because the markets have been less than favorable during the month of October, and as November starts, they didn't really necessarily start in a positive note. So, as you probably saw on the report, the retirement plan at the end of September had a quarterly return of 1.4%. It's not ideal. If you remember, our discount rate, or what we're planning for the year, is a 7% return for the year. A quarterly return of 1.4%, especially when we had pretty weak quarters in the first and second quarter, is not ideal. We were hoping for a boost in the third quarter, and that didn't happen. It's positive. It's not as positive as the index, which was 1.9%. We have financial advisors that help us figure out, are our investment managers doing a good job? We benchmark them against different indices. This time our index was higher than our return. Sometimes it's the opposite. We believe that it's within that reasonable range. The fund itself at the end of the quarter had 1.01 billion. So we gained. At the beginning of the quarter, we were at 1 billion. So it's just a very modest gain for the quarter. Our employee contributions were $2.64 million. OPPD contributions were $13.4 million. And earnings on the fund were $14.02 million. That slightly more than offset the benefit payments that total $24.16 million. It was you could call it a flat quarter. We made up a little bit more than what we disbursed. The word of caution here is October. Just in the month of October, the stock market lost somewhere around the 6%. Now, we're not just invested in stocks. We have a diversified portfolio, but I'm cautious for the fourth quarter report on this. It's likely that we will have significant losses for the fourth quarter, and that'll probably be something that I will report sometime later in January next year, unless we have a phenomenal rebound in November or December.
I'm always looking at the real estate, since that's new.
Correct.
You know, that's a new alternative asset manager, and it seems to be doing okay.
It did well. Private real estate did well. So did domestic equity. But remember, this is for the quarter between July and September. And it did well, and we had offsetting categories like international equity, which didn't do so well. So I think your point is that diversification decision we made a few years ago, it's paying off well in the plan.
You briefly mentioned the first and second quarter returns, but can you quickly remind me what those were?
I don't have them with me, but I can follow up. They were pretty flat.
Right? Yeah.
Yeah.
Okay.
Whatever they were, they disappeared in October.
Yeah.
Everything just, yeah.
Right. But that's a follow-up item. I'll
Sure.
think about it.
Yeah. No problem. I'm just curious.
Any other questions or comments on the retirement plan? Okay, the third item on the agenda is the legal fees and expense report for the third quarter of 2018. Again, same quarter of 2018. Legal fees and expenses paid to General Counsel Fresher Stryker total $281,844.45. For context, Last year, same quarter, fees paid to Fraser Starker were $235,000. This time around, we're a little higher. Just a reminder, in the third quarter was when we executed the bond transaction, the cash defeasance and the bond transaction, which were two separate transactions, so that required additional services, and also probably picked up by work on economic development and other items that we didn't have last year in the third quarter. Legal fees paid to Special Counsel Hogan Lovells totaled $20,719.30 for services provided for environmental regulations. We did not have these expensed last quarter, and again, this has specifically to do with services for environmental regulations. Legal fees and expenses paid to Special Counsel Kutak Rock. This is our bond counsel. Total $17,500. Last year, the same quarter, were only $2,500. And again, this is the timing of the bond issuance that fell on the third quarter, and last year it was on the fourth quarter. But they're pretty much in line with what we've paid in the past. Any questions so far? Okay. There's a reporting item. The next item is the preliminary corporate operating plan. You have in front of you 2 pages of a reporting item that summarizes what I am about to go through here on the slides. So instead of me reading you the reporting item, I'm just going to go through the slides, if that's okay with the board. Okay. It is a pleasure for me to report on these. It's been a lot of work for a lot of people here at OPPD, but it's really not just a 1 year's worth of work. It's, I would say, several years worth of work representing what I'm about to show to you. This is the corporate operating plan, or what I would refer to as the budget for 2019. And it tells a really compelling story. We have continued to do great things at the district, and we're doing them in a financially sensible way. So to start, this is the takeaway. We are presenting this for the board and our customer owners to consider. It'll be out until the next board meeting. I was going to say 30 days, but it may not be 30 days exactly, but until the next board meeting. We will ask the board to vote and approve this plan at the December board meeting. The takeaways here is that there's a no general rate increase. This marks the 3rd year in a row, 3 out of 5 years of a no general rate increase commitment. There's also no change in the fuel and purchase power factor. That's really important. And we're also going to ask the board to reset the fuel and purchase power base rate to better adjust and better reflect what we're seeing in the market. All of these without raising either the general rate or the FPPA factor. That's.
Could you expand that and how you do that?
I will.
Okay.
The retail energy sales, there's an increase of 3.1% from what we thought retail energy sales were going to be at the time we did the budget last year. We've actually had significantly higher sales this year. We had weather patterns that were not normal or were different than what we expected in 2018. So our retail energy sales for 2019 are almost flat from what we're projecting 2018 to finish at, 0.02% decrease from 2018 projections. Wholesale revenues, there's a big drop in wholesale revenues that we're projecting for 2019. The majority of this is a reflection of, we will have 2 major outages, planned outages into our coal generation facilities that will reduce the amount that we will be able to put out into the market, and wholesale revenues there follow that same pattern. On expenditures, we continue to invest in capital, operating, and maintenance expenditures. Again, our goal is to maintain reliability for our current and future load growth. We will continue to fund for Fort Calhoun Station Decommissioning Trust, now under the deconstruction model, and I'm sure we'll hear about this topic later on. That's embedded in the budget. We will, on the financing side, this is a very important piece. We will continue to plan to fund our capital plan without issuing new money to fund that plan. We are retaining the ability to issue debt and finance to take advantage of market conditions, but the budget that we're presenting does not assume any debt issuance for new capital. That is fantastic. It's phenomenal. It's going to be the third year in a row that OPPD will not have to issue debt to fund capital expenditures. It's significant. It's not the norm, and we're doing it because we've been planning for this for a number of years. And as you remember, last year the board authorized us to increase our rate stabilization reserve fund to $50 million. It has stayed at that level, and we plan for it to stay at that level. We won't have to dip into the rate stabilization reserve, which is really important for us, especially as we're in the rate freeze window. For us to, when we come out of that rate freeze window, to have a fully funded rate stabilization fund. It's important that we're not using that to maintain the rate freeze. If you recall last year, we funded the new decommissioning and benefits reserve account with $35 million rounded. We're expecting to be able to fund an additional $35 million into that fund this year. This is going to require board action to approve that funding. That'll bring that funding up to $70 million. And the current budget plans to generate an additional $12 million to be deposited into that decommissioning and benefits reserve in 2019 for a total of $82 million.
Now, that $35 million does not hit the P&L statement because we took the loss in 2016. Is that a fair statement? This is a cash issue, not an expense issue.
It'll be an expense issue, actually, and we're actually sizing this deposit so that we can still meet our 2 times debt service coverage ratio.
Okay.
So these are earnings in excess of the 2 times debt service coverage ratio that the board can decide to then put in this decommissioning and benefits reserve account and still meet the 2 times debt service coverage. If we didn't do this, our debt service coverage would be higher than 2 times. And so we're designing these to meet the 2 times debt service coverage. So it does hit our income statement. It's reflected in the income statement.
Javier, the 82 million, is that a target that we're trying to hit by 2019, or are we looking to continue to grow that? Or
That's a great question. Just a reminder, these funds, when the board approves deposit into these funds, there are only 2 uses that can be used without further board approval, and that's either to fund decommissioning or to give a boost to our pension funding. On the decommissioning side, we still have about $1 billion liability. We continue to make good progress, and we will continue to chip away at that liability, and every single report I get from Mary Fisher and her team at Fort Calhoun shows that we continue to come under budget. So, but still, the liability is out there. So, $82 million on a $1 billion liability sounds reasonable to have for variations. The other piece, if not used for decommissioning, these could be used for benefits reserve. Just a reminder, our unfunded actuarial liability is over $400 million today. I just talked about our pension fund sitting at about $1 billion. Our total liability, net present value liability, is over $1.4 billion. So these $82 million would compare to the unfunded liability of $400 million. That would it's still not in excess of that, and it would be potentially a very good use of these funds to advance but not exceed our funding requirements.
But it's not in the same way that we've got 50 million as a target where we're sort of comfortable with our rate stabilization. This is not a target where we're stopping.
That is correct.
Okay.
That is correct.
All
And the $50 million is it's a target, and it's also a target based on what rating agencies recommend, and looking at it's a little bit different of a target. This one it's just for OPPD based on the liabilities that we have.
Thank you.
I mentioned the planned outages. We will have the 2 largest ones, Nebraska City Station Unit 1 and number 2. There's a lot of work and a lot of dollars that are going to go there for capital and expense, but also very important in the budget is the energy that we will not produce from those plants. So we have to balance that budget year over year, and this coming year is going to be a tighter budget in terms of energy output and costs or investments into the plant. This is a graphical representation of retail revenue at $969 million. I mentioned we're pretty flat on the amount of energy we're selling, and we're flat on the rates we're charging. The slight increase you see here has to do with the different customers who are using more or less of our power. You probably can't see these very well because it's a very minor increase, but we're expecting an increase in commercial and industrial customers compared to the residential. You've seen a lot of activity on economic development, and it's part of that. One of our large customers who started construction a couple years ago will start taking power, and you'll see that reflected in the 2019 budget.
Will the actual numbers be in a table in the larger plan?
Correct. Yeah.
Thank you.
Yeah, this is just the Cliff Notes for presentation. The actual numbers are in the COP at an aggregate level, so industrial, commercial, residential, not by specific customer. Wholesale revenue, this is a story that I was telling earlier. We expect a decrease in wholesale revenue, again, mainly driven by a decrease in output of energy. You can see the blue line, it relates to NC2. We're expecting an outage on NC2 that will lower revenue for that unit, and a larger outage for NC1 that will also it's also reflected in that table. On the other operating revenue and non-operating income, the story here is interest rates. You can see that all the categories except for the blue one, which is investment income, are flat. Investment income is increasing. Interest rates have doubled from what we assumed in 2018 to what we're assuming in 2019. So we have large balances in the decommissioning trust fund and our cash balances, which are earning a significantly higher interest rate compared to what we were in 2018, and even more so compared to 2017 and beyond. On the O&M expense side, this graph looks easy. It's just a pretty flat picture on 2017, 18, and 19 for O&M expense. I can assure you that it was not an easy task to get here. All my colleagues here and the senior management team can attest to these. We endured rigorous and lengthy discussions on prioritization of spend. How are we going to live with pretty much the same dollars that we've had here in the past 3 years? And so I'm happy to report that we were able to find a good solution that it's a balance. It included a lot of trade-offs and prioritization, but we are keeping the lights on, making sure that we have reliability, that we're keeping our investment in the plants well, and in customer service, business technology, etc., but still living with the same amount of dollars that we've had in the past couple of years. Yes?
On that, I don't know if we ought to do it today, but at some point, when you keep cutting expenses all the time, I'm all for it at the right expenses. But too many times in government, they just keep cutting, and they do terrible service. So let's don't fall into that trap at some point. If you're at the bare bones, you're at the bare bones. I think you should tell the board, because, I mean, I'm just sick of seeing that. It's like cut, and you say you're doing something good, and you're really not. So at some point, maybe next year early, let's kind of refresh us all of what we've done, because I know you do that every day. But I think it would be good for the full board to hear, here's what we're doing. Yeah, because it's a challenge, I know, and we appreciate it, but there's also a certain point where don't go beyond this point.
Well, I think a great example, and I'll use tree trimming as an example. So, we typically spend, I'm going to say $8 million in tree trimming. Let's say something close to that. 7.5. So Troy's nesting over there at 7.5. So our plan in this is to increase that another $1 million. But we're also doing some deeper dive work that you may see even a change in next month's kind of corporate operating plan, that we may increase that even another $1 million, right? Because of that, because of some of the tree damage that we've seen here, some of the growth patterns that we've seen that have been greater and to get us for multiple years to do higher level tree trimming. So that would be an example where, we've probably kind of dropped down and now we're going to build back up again and try to maintain a more common standard around tree trimming. But you'll also see in some other work that we're doing around the reliability SD4, around the work we're doing not only in the power plants, but the work we're doing on our T&D and transmission system and reinvesting to maintain those high reliability indices. So you'll see that next month as an SD review, I believe, a monitoring report. So we're looking, we look at that all the time, and we'll make sure that's not the case, that we don't cut cost and reduce reliability, reduce customer service. I think we're measuring that in a variety of ways, and so but I appreciate that same thought.
And to augment to your comment, it's not only just cost cutting, it's also cost redirecting, right? Are we getting the best bang for the buck on the programs we were using before? Can we redirect them? It's not necessarily cutting, but using them in a different way. Very important for us to know, and thank you for that. It's a warning of a tail that happens every now and then on electric utilities, where you cut, and then you get to a point where you have to increase rates significantly, right? And so one of my main objectives is, as we continue to prepare these budgets, is to make sure that we have a good path for post 2021, after we're out of the 5-year no rate increase, to have a plan to continue, or if there's a rate increase, that make sure that it's not dramatic, right? To make sure that we haven't necessarily been cutting too much to the point that now we have to have an increase.
To echo what you said, and just quick question, I assume that the big difference from 15, 16 down to 17 is Fort Calhoun, is that
Correct.
right? Okay.
Correct. So I apologize for not getting in there.
Sorry.
It's obvious to me, but maybe not obvious to everyone. Absolutely, the Fort Calhoun operations used to be considered operating and maintenance expense back in 2016. When the plant ceased operations, that amount is no longer considered O&M, and therefore is no longer expressed in this table. Now, we still have to spend quite a bit of money decommissioning the plant. It's in a different bucket. You don't see it here. That's a change. Thank you for the clarification. Capital expenditures, 2019 is going to be a busy year for capital, and I think all hands on deck. As you just heard me talk about the 2018 capital underspend, this is something that we're going to pay a ton of attention in 2019. We have a significantly higher budget. Now, in here we have large capital projects. A lot of them are associated with the outages in our generation plants. We also have a few large projects on transmission that are causing this increase in capital. So this is something that the planning teams and project management teams are going to be focused on to track and try to execute our capital budget as planned.
Now, planned outages, you can only capitalize that if it extends the useful life, is that correct?
Yes. Yes, so not all the work in the outages is going to be capital. Some of the work is going to be expense.
Yeah. Okay,
So-
you're drawing a pretty bright line on that, Laura?
Yeah.
Okay.
Yeah, this is,
Some projects would be capital.
there's quite a bit of tension between our accounting department and the plants, of course, because we're trying to do the best work, and they're pushing one another to make sure that we're following the capitalization policy to the T. Something I want to mention here, you can see the increase in that green bar. It really represents those outages, right? The capital investments in generation are increasing in 19, mostly to fund those outages. Increases in transmission, I just talked about some large projects for reliability. Something that may be lost, but I don't want to be lost, is the increase in that gray bar, which is other. We made a conscious decision from 2017 to 2018, and we are continuing that to 2019, to increase investments on other. And other includes business technology. It includes fleet. It includes facilities. All the things that are not necessarily that visible to operations, but are necessary for those operations. And so I'm very pleased to see that we are making those right investments to continue to help the organization move forward with all the initiatives that we have planned. This is just a sample of some of the large projects that we have. I'm not going to go through all of them, but you can see some large transmission projects in the 15 to $20 million range. All of the production projects in there will be done through the part of the outage. So I'm just going to move on from.
Can we go back to that and talk
Yes.
about the transmission again? Is that transmission lines that we have not yet voted upon or anything yet?
These are transmission lines that, part of the transmission work that has been presented here to the board in the previous months, the SARPI line, some of the substation work, that's that type of, it's not a new line necessarily,
That's what I
but
was
it's
wondering.
reinforcing existing paths
Okay.
to increase reliability. Pretty easy slide here, no new money debt financings planned. This is going to be our 4th year, consecutive year, which is phenomenal, in my opinion. This brings me to the net income picture here that shows the budget has a net income budget of $78 million for the end of 2019. We believe that we should be able to deposit an additional $12 million in the Decommissioning and Benefits Reserve account at the end of next year if everything goes according to budget. If it doesn't, if we get higher fees or higher expenditures during the year, that amount may disappear, or vice versa. If we get a good market, that amount may increase. But we believe that range, that margin is appropriate for an operation that's at a $1.1 billion annual funding. Rate stabilization account balances, I already talked about these. We reached the $50 million amount in 2017 and are expecting to retain it at that level. Decommissioning and Benefits Reserve account, I just talked about that. This is the projected path. Decommissioning fund balances, this is the other piece. So Director Moody talked about the drop in O&M. That drop in O&M expense from 2016 to 2017 was offset by additional funding into the decommissioning trust funds. And you can see here, we started expenses really in 2016, but the heavy expense happened in 2017 as we went full on board with decommissioning work. It has continued to 2018. It will continue to 2019. And I am pleased to report that we are depositing in to the trust fund more than when we are annually using. And that's by design. So that the plan is that we will have enough money in that trust fund to continue funding decommissioning somewhere in the 2022-2023 timeframe when the fund should be fully funded, but the decommissioning work may not have stopped. Again, that was part of the plan when the board approved the decommissioning, and we're sticking to that plan, and it's working as planned. Our debt ratio is an important piece of this equation. I get asked a lot of times how much money we owe, and we have a little bit over $2 billion in outstanding debt, and that sounds like a lot of money, but it's really when we compare it to the assets we own. This ratio really measures that how much do we owe compared to how much do we own in assets. We started in 2015 with 51 cents. That means that in 2015, for every dollar of assets we owned, we owed 51 cents on that dollar. A pretty healthy metric. The median large public power ratio, it's in the mid-50s to 60% rate. Our ratio spiked in 2016. We did not issue debt in 2016. However, we did decommission Fort Calhoun station. So from an accounting perspective, that asset did not longer qualify as an asset for the formula. So it caused the ratio to go up. As we continue to invest in more assets and we do not issue new debt and we continue to pay down the existing debt, that ratio has continued to come down from 66% in 16 to 59% as projected in 2019.
And our current debt, what does it compare to? It's been 3 years since we had to issue.
3 years, we're going into the 4th year.
Okay. Where do we stand as far as existing debt compared to where we were 3 years ago?
In dollars and cents?
Dollars and cents, yes, I'm sorry, not ratio.
We were a little bit a little bit over $2.1 billion of debt outstanding. We've paid off significant amounts of debt. Now we are a little bit over $2 billion. So we've continued to chip away at paying down that principal without adding any new debt. And we are also adding to the asset base.
Correction, it's been about 2 months since we issued new debt, because that new debt had nothing to do with the debt we retired.
It's the defeasance.
Yeah,
Yeah, right.
so it's been 2 months. Right?
Correct. We issued new debt for purposes of lowering the interest rate of our overall portfolio.
Let's be.
We're trying to
We
take
defeat them.
Yeah, that's right.
That's not fair, Mark.
But we have not. It has been 3 years without us increasing the overall principal outstanding from the year from when we started in the year.
Okay.
Do we have a target level for debt ratio?
We do. It's not a hard and fast target, but we have expressed our in conversations with the rating agencies our desire and our plan to bring us down back to the lower 50%. Whether it's 51% where we were in 2015 or 52%, it's in the lower 50s. That helps us maintain our credit rating, and it keeps us in line with other higher rated.
It'd be nice to see a line on here that is the target. Soft or hard target, it'd be nice to see a line.
Yeah, when we originally, in 2016, when we took about $1 billion write-off because of the Fort Calhoun asset, we actually had kind of where that line had been in previous years, which is around that 50-50 is where we wanted to be on the debt equity. And that was kind of our long-term forecast, but that's, I think we'll take that advice for next month and kind of show where we want that to be. But our plan is to actually get there over a period of time, so.
That doesn't necessarily mean that once we get there, we want to issue debt to stay at that.
Oh, no.
No,
Okay. I just wanted to-
absolutely.
No.
All right.
Just nice to see
Absolutely.
what the target is,
Yeah,
though,
yeah.
when you're talking about it.
Yeah.
Right. And in fact, good reminder, the fact that we have not issued new debt, we have not increased the amount of our debt portfolio in the past 3 years and going into the 4th year, does not mean at all that we will never issue debt again, right? We're reserving that tool, that financing tool, for whenever we have large projects, like when we build Nebraska City 2, or some other large project that requires more funds that we can collect on a single year from ratepayers. We've been able to pay cash for all of our capital expenditures year over year because those have been relatively small in comparison to some of these large projects.
So just a quick scenario on that. When we issue that kind of debt, based on the previous conversation of 2 times debt service coverage, so we, of that mortgage payment, we essentially try to recover twice that in our rates,
Right.
which really puts pressure on the rates piece. So we've been very diligent about how we go through and use current cash to do the capital projects that we're doing today. And we're very sensitive about that and how it impacts and could impact rates.
Well, and we have 460 million in
Correct.
cash.
Correct.
So that's a big war chest. Which really helps, because
Perfect.
debt is gonna get tougher and tougher as interest rates keep climbing.
Perfect segue into the next graph, which is the 2 times debt service coverage. That light green line in the middle of the screen is really the one that we are laser focused on, maintaining that 2 times debt service. Let me remind everyone that our legal bond covenant requires us to maintain that coverage at 1.4 times debt service. We have chosen to do it at 2 times debt service, and that is helping us maintain our credit rating with investors. The increase in the orange line is another optic result of the decommissioning of Fort Calhoun. We lost a lot of O&M expense, so that artificially increased our coverage on the orange line. I'm not looking at that one very closely because we know that it had to do with the decommissioning decision. It's really that middle line of 2 times debt service coverage that we're focused on, and frankly, the entire budget is built upon these one metric of maintaining at least 2 times debt service coverage for 2019. The bottom line, the dark green line, if you're asking what the difference is rating agencies have issued notice, and they've said, we understand that the dynamics of the utility industry are changing. And many utilities, instead of building their own wind farms or solar farms, are contracting with private developers. Therefore, you enter into long-term power purchase agreements with them, and even though it's not debt, they see it as a quasi-debt, a quasi-fixed obligation. So they have issued guidance on how to calculate a fixed charge, which is shown down here. For purposes of our ratings discussions, we're still using the 2 times debt service, but we are being transparent and showing what our PPA charges are and how that affects our fixed charge.
That's not part of the debt service, right?
It's not part of the debt service coverage ratio, it's part of the fixed charge ratio.
Yeah,
They're
so
separate
separate.
ratios,
Yeah.
but again, since the utility industry has evolved into this PPA world, we are now reporting those two separately.
Yeah, okay.
It's an off-books commitment.
Days cash on hand, I mentioned this briefly. We're expecting to end the year at 250 days, and the budget for 2019 shows us ending the year in 2019 with 259 days cash. It's a healthy number. It's not yet as high as the median of other large public power entities, but we're I believe we're making good progress and feel comfortable with the amount of cash we have to operate.
Javier, that's good success, and thank you. But that's the second time you've mentioned it's not the median. Can you give me a range where that median is?
It's in the 270 to 280.
Yeah.
But that's an old median. We don't have the medians for 2018 yet. As soon as they are published, I'm happy to share those with you.
Sure.
So we're comparing a little apples to oranges. This is 2019, but the latest median we had is from 2017. So I'll share with you when we
I
have
just
them.
wanted to know how big the delta was.
We're not that far off,
approximately.
but we're still not as high. So we're
Gotcha.
280 days would be closer to what that median might be.
Sure. Thanks.
Okay, so Director McGuire asked a little bit about the fuel and purchase power recovery. Just a general overview. Fuel and purchase power is collected through 2 mechanisms. One is general rates, that's embedded in the base rate. And then we have a fuel and purchase power factor. That is a factor that moves up and down as the year goes by, and our fuel costs and purchase power costs go up or down. And this is a resolution that the board approved many years ago, and we've had that factor ride up and down depending on each year. It provides stability to the rates. It gives also management a lot more planning guidance when it comes to budget.
Javier, does that change on a monthly basis, quarterly, annually?
Annually. Annually. There are many utilities around the country where that one changes quarterly or even monthly, where you as a consumer, you can see your rate go up and down every month or every quarter. We have chosen to do this annually, again, to provide more certainty and stability to our customers. On the general rates, the idea is we will collect the base fuel and purchase power costs that we're anticipating in the next year through general rates. And as I mentioned, we're planning to have a factor that varies year over year, and it's automatically adjusted. The board doesn't need to approve it. It resets every year. Doesn't reset, it changes every year. Last year, just a reminder, last year in 2018, there was a very small increase in the factor, de minimis increase in the factor. This year, we're proposing for that factor to stay flat, and I'll talk about this in a minute. A few things happened last year that are, I would say, one-time in nature. When the FPPA formula was designed many years ago, and this is not only true for OPPD, but for the majority of other utilities we've worked with, our rate consultant, the board's rate consultant, verified these, is that formula was designed in a world where we didn't have integrated markets, or we didn't have the same activity in the integrated markets. Therefore, the majority of the fuel and purchase power cost was really just fuel, right? There was a little bit of purchase power, but the majority was on fuel. Fuel costs would go up and down, and that would be the reason why your factor would go up and down. As time has gone by and we've integrated ourselves into markets, and we've added more and more purchase power agreements. Not only are we purchasing power from the market, but we're purchasing power from agreements. So the world has become a little bit more complex. while the formula hasn't. We still have the same formula. So an example of these was last year we had an under collection of funds, which was material affected by unplanned and sustained high voltage transmission outages dating back to 2017. This is when we had the tornado go through Bellevue that took down one of our important transmission lines. That's a one-time event that I mentioned earlier. Well, that caused some price volatility in the market, congestion from south to north that we were not planning on. These started to happen early in 2017, as early as June of 2017. But for purposes of the 2019 budget, we are looking at the period between December of 2017 and May of 2018, when we paid more money to purchase power than we had budgeted for. The price differential was significantly different and something that we didn't plan through that event. Doing nothing, if we let the purchase power formula go through, we would basically put it in the formula and we would increase rates next year to recover for the $22 million that we paid more last year. Well, that would be wrong, because also during that time of the year we entered into financial hedging transactions that helped offset those additional costs. That other offsetting piece is not part of the formula. So we're going to be asking the board in December to forgive the under collection that happened in 2017 and early 2018 due to this one-time event, because we, on the other hand, we almost offset that loss with hedging transactions. So that's a good example of when we're asking the board to deviate from the formula to make a board decision that it makes sense for our customers, that doesn't raise rates to our customers that we wouldn't need otherwise, other than the formula would tell us to do that. Does that make sense? We also have from June of 2018. Yes.
Javi, just I want to make sure it makes sense on what we're trying to do. If we just followed the formula, we would have probably increased the FPPA, but because of the one-time event, we decided, and because of kind of the financial projections we have in the budget in 19, we've decided not to do that, and to keep the general rate piece in the FPPA the same as it is, and no adjustment to that. So I just want to make sure we all understand what we're doing and why we're doing it.
And what would happen, let me just, to finish that thought, what would happen is if we let the formula go through like these, we would have an increase in 2019, but barring any other tornadoes, we would then have a decrease of about the same size for 2020, which is whipsaw rates. And again, this is in an effort to maintain those rates stable and to reflect the revenue that we receive from hedging transactions. It doesn't completely offset it, but it almost offsets that.
Is this a one-time exception to the formula?
Correct.
Or are we adjusting the formula?
No,
going forward?
these one is a one-time exception to the formula.
Okay.
Where we are adjusting not the formula, but this is going to be another action item for the board, is we are also proposing to reset the fuel and purchase power base to better reflect what we are spending for fuel and purchase power for the district. When we do this is a really important graph. It might be hard to see it in the graph, but here at the bottom you can see these. We're proposing to leave the fuel and purchase power adjustment, the factor, the same as we had in 2018. We're proposing to increase the base fuel purchase power general rate to better reflect what we are expecting to spend in the market. And we are making an identical decrease on the all other general rate downwards. That keeps our average all-in rate the same, and we believe this is a financially prudent action to take. We have been improving our financial health. We have the means to do these. We believe that this is the right thing to do for the customer, and it doesn't necessarily put undue burden on OPPD. It puts us in a much better place for 2020 when we will have a base rate for fuel that more closely tracks what we're expecting to see in the market. We will still have a factor that may go up or down next year, but the base rate will make that factor adjustment lower because we're having a base rate that more closely matches what the actual expenditures are going to be.
It sounds to me like we had about $20 million worth of hedging gains. And
Yep.
what's to say that won't happen again? Did we change the program so it won't happen again? Was it luck? What's the difference there?
Lines
Troy?
back in service, so you don't have the same congestion format that you had during that time period.
Okay, so we leveraged the congestion charge by our line.
So we
Change-
had, we
I mean,
had,
caused by
we
our-
had financial hedging in place that offset that differential that we saw on our assets.
Okay, let me say nicely done.
Now,
Very nicely done.
Just for the record, this is something very, very important for regulatory standards. Our trading floor had no idea what was going on when the transmission line was out. We have a very specific standards of conduct that doesn't allow for this information to happen, precisely to avoid these type of results. However, our marketing function saw the differential in prices, and not knowing exactly what caused it, they started entering into these hedges. So it's an important piece for me to be on the record for standards of conduct.
We have a pretty defined risk management system where we look at our generation, we look at our load, and we make sure we have the appropriate hedges in place. So most of those hedges were already in place well before we knew the extent of what was going on with this line, so.
Okay.
And just to remember on this line, this was a wood, I believe 161 structure, 345. 345 structure that we replaced from wood to steel, obviously to improve that resiliency and the structure of that 345 line.
So Javier, on this, on this rate, so 2019 is the last step up in our fixed
Charge.
fee, right? So it goes up to 30?
Correct.
And my understanding was over time, that was a revenue neutral
Correct.
approach, right?
Yep.
So, which leads me to conclude that as the fixed portion goes up, the variable portion of our bill is going down.
Correct.
So, I'm just kind of,
And that fixed charge, by the way, is included in here.
okay, that's where I was going was.
Yeah.
Okay, so it's all rolled in and that's just,
And this shows you that netting is happening within that.
got it. Okay, thank you.
Can you explain, since we mentioned the fixed charge, that what a fixed charge is, so people can understand that?
Yes, so the fixed charge is a way for a utility to recover revenues in a fixed way that should match the fixed expenditures that a utility has. On the other hand, the utility also has variable expenditures like fuel, for example, that are also recovered in theory through a variable piece of the bill. That match is not perfect. It's not perfect in most utilities. In fact, it is very lopsided, where the fixed charge in most utilities is tiny, and then the fixed expense piece is significant. OPPD's board of directors a few years ago made a decision to transition from a very low fixed charge into our fixed charge that next year will top at $30, on average $30 per customer per month. Started at sub 10 and now it's going to 30. That was done in an effort to better balance the composition of fixed and variable expenditures with fixed and variable revenues. It's not perfect. In fact, this is when this was presented to the board a few years ago. If the board had chosen to match these perfectly, the fixed charge should have been somewhere in the order of $70 to $75 to cover the $70 to $75 of fixed expenditures that OPPD has to make, leaving another $25 to $30 as variable charge, right? But the board chose not to go all that way and chose to cap it at $30 in 2019. does that help?
Yes, thank you.
And we're seeing other utilities begin to
Yeah.
move in that direction as well. Some within the Nebraska region and some of the proposals that's gone on with other utilities as well. Some are close to that, and some are even moving higher to that in some cases, so.
Right. And that gives OPPD the financial stability, the foresight of knowing that your revenues are not changing that much and that you can actually match your revenues a little bit closer to your expenditures. And it allows us to look forward and plan and contemplate some of the programs that today, frankly, we wouldn't be able to contemplate if we had a revenue piece that was changing so much without having that certainty that we will cover our fixed expenses. Now, on the other hand, going back to Director Gay's point, we are trying to lower all of our expenses as we can. We continue to refinance and our debt and make our debt portfolio more efficient, and that helps us lower our fixed charges, but it's still not perfect. It's still pretty far off.
I want to come back to restructuring the FPPA and Director Moody's comment about it being a one-time event. When we talk about base fuel, the change that we have on this slide, that's the one-time event that...
There's two. Resetting the base, the fuel base rate higher. That's what you see in this slide. The other one is the forgiveness of the $22 million one-time event from the storm. That's a separate issue. That has nothing to do with resetting these. It's basically we are choosing. The board would choose not to include that in the formula because it would only result in a decrease in the formula for the following year. Again, we're not recognizing the revenue that we're getting to offset that expense. So there's two separate actions that will ultimately result in this no general rate increase and no fuel power purchase adjustment for 2019.
Good.
Okay.
I feel like I almost have my mind wrapped around it, but it's...
Well, I think our feeling was, if we can keep, rather than doing the up and the down, right? If we can keep it levelized, that's better for all customers, and I think you all would agree with that.
Yeah.
And so if we saw that one-time event and then come back down again, if everything was normal as we have projected, we just said, is there a way for us to do that? And we're financially in a position to be able to do that. And we thought that was really the best, at least the best recommendation for management as we begin to look at 2019.
And to that normality, whatever that is in the world of weird weather, I do appreciate that there's reinforcement and investments being made in strengthening transmission and distribution, so to help protect against should there be another weather event.
Yep.
Correct. And those, by the way, happen not only in our footprint. I think it's important to remind everyone we can control what happens in our footprint, but we could have those events happen outside our footprint. That could also affect prices. So that's another risk management issue that we were managing around to make sure that we have enough cash and that we have good rate mechanisms to help us weather market anomalies that happen for reasons outside our footprint. So it's those two.
Thank you.
Yeah. Well,
Javier, quick question as it relates to SD2 and our goal to be 20% below the regional average. It's all in, right? So it's all three portions of this. It's
correct.
Not just okay.
Right. And as we stated in SD2, our goal is to have a 5-year no general rate increase, and by doing that, the assumption is as other utilities are having a harder time maintaining these, our competitiveness against the other utilities compared to the region should improve in the long term. That's our directional goal. Okay. The board has two different consultants. One I already mentioned, Brattle is your rate consultant who looks at the FPPA in this case. They are finalizing a letter that will be included in Diligent for you in the next few days and will be part of the official board packet in December. It's a consultant basically telling you that what we're proposing in rates meets all the statutory requirements and it aligns with best practices across the nation. The other consulting service that the board has is new gen strategies and solutions, where they look at not necessarily the rate, but they look at our budget. Is our budget reasonable compared to other utilities? Are we spending about the right amount of time, the right amount of money? Not too much or not too little. They will also alert the board if we're spending too little on certain programs. And they've concluded their analysis. There will be a letter out, and basically they concur with the solid basis that we're using to prepare this budget.
So that goes to Director Gay's comment a little bit.
Excuse
right?
me.
That goes to Director Gay's comment about where we're
Make sure that
spending
we're
and making
not
sure we're
artificially
spending enough
doing
money.
something that may come back and bite us in the future. Correct.
And do we get a report from them? What do we get?
You actually get a letter, I think.
We get a
that
letter
talks that
from-
They've essentially gone through this analysis and review and met with, not necessarily the senior managers, they met with the subject matter experts on what our programs are, what we're doing, how we're doing our recapitalization, our replacement, our, and then all the data that they request in that process. And then we get a letter to say, you know, here's what that is. I don't know if we have that letter
Yep,
yet.
It's right here,
We have that, okay, so,
November 15th.
in the corporate operating plan.
Right. That's part of the.
It's done every year. It's done every year.
So we get a little, Sean will have to look at this yet, so there's a little letter in here on
Yes.
there.
Back-
What about the
very back-
details
very
of
last
that?
page.
Yep.
Are the details,
There's no detail.
is there anything with it, with that
No,
letter?
no, it's
So,
not.
so to your comment, Director Gay, then it might be nice to hear from them as well when it's.
I'd obviously do a big review of everything.
Well, I mean, just, you know, something a little more detailed than the letters when, as you requested, the issues brought up for the board next year.
To me,
Now,
it sounds
all
like a
the
comfort
details are
letter.
included in that book,
Just a comfort
right?
letter.
And they're
At this
commenting
point,
on,
yeah.
they're commenting on.
I'm sorry,
the
we had
details.
some back and forth here. Go ahead. I didn't hear what you said.
All the details are included in the book. So the first 50 pages has all the details of the budget, and they're opining on that budget.
Okay.
So the letter we have here is that they haven't completed their analysis to date, but the information that they've reviewed to date, I think we may get a different letter next month with the final review.
With the final one.
Essentially, it says the data that they've reviewed today has not raised any issues or concerns from them on the profit allocation of either OMN or capital and the operation of the district. So let us go back and see what the support material they would have to support that.
Interesting to see. It's
Yep,
just an outsider's
fair enough.
perspective of what
Yeah,
they're doing.
no, I understand. Yeah, that's great.
Is this
It's
a
like
new?
the rate consultant.
No, we've been using them for
You
years.
have been using them, okay.
Mm-hmm.
Okay.
Yeah. Actually, we've been using this individual through a variety of different consultants.
That's what I was thinking. He's
Yeah.
the same man, but.
Same
different.
person for a
But a
long
different
time,
company.
15 or 20 years.
And they, from time to time, they do issue letters saying, hey, you need to keep an eye on this and that and that. And this year, for whatever it's worth, Mr. Vanek did mention to us that it's been fantastic. It's been the best year that he remembers in OPPD's history because of all the actions that we've been taking year over year that are leading us to having a solid budget that reflects good management practices for a utility.
Javier, is it fair to say that a very simplistic way to look at 2019 is the $12 million that we're going to add to the reserves is really being funded by $15 million in additional interest income?
Correct.
Okay.
Which is
Just cut to
a
the chase.
financially
It's kind of a
prudent
simple
way of
way to
doing
look
it, right?
at it.
So the additional income that we're getting because of variable interest rates in the market, we're not embedding that into fixed programs that we may not be able to afford when those interest rates go down. So it's variable. Yes.
I have a process question.
Yes.
I think since I've been on the board, there've been only two rates that we've had to approve, 261M, and I believe the
500.
Yeah, solar
solar
rate. Yeah.
right?
500.
So I'm kind of curious about if we ever arrive at a need to actually adjust any of our current rates, whatever they may be, when does that happen? And does that get sort of baked into, right now you're assuming no rates will
Right,
change for
right.
2019 at all, right?
Yep.
So
it would
that's
happen-
part of your budgeting process to look at those rates to make sure that they're appropriate, is that right?
And it would happen, so in an environment when there's a rate increase, let's just hypothetically talk
Yeah.
about that. That conversation would happen now with a final approval in December. Now, that would probably be preceded by several other meetings.
Right.
Preparing and educating the board on what the needs are and what the changes and how could these end up becoming a rate increase. In this time around, you didn't get that education because there's no general rate increase. This is one of the beauties of having that consistency for that period. But from a process perspective, that's correct.
Okay.
One of the reasons why, now technically, the board could choose to reset rates or increase rates halfway through the year, right, if you needed to. This is one of the reasons why we have a rate stabilization account that also would help us. If we had to, we could draw from that account without having the need to reset rates halfway through the year and still observe the process that we have in place today.
Okay, thank you.
Okay, so next steps, these will be out for comment, for your review and perusal. And we will meet again at the board meeting in December, where the board will be asked to approve the 2019 corporate operating plan. That's a statutory requirement. We need to have an approved budget for us to start the following year, and the rate actions that I just described. Something to expect. In front of you, you have the preliminary plan. You will have a different version in December with the final plan. It's going to be almost identical. There might be a few changes here and there. There should be de minimis. However, there is one change that we're planning on these, and Tim Burke already alluded to these. It's an increase to the vegetation management budget of an additional $1 million to continue to increase reliability, and this is something that we've been studying, and we believe we can make it fit in the budget, and it should help us increase reliability and lower SAIDs, et cetera. So that's the one change that it's not in here that you should expect to see in the December final plan. And with that, I conclude my presentation.
Nice work. This looks very good. I can't find any holes to poke in it. And I'm looking.
You will.
I know you.
We know you are.
No, it's good work that went into this.
Well,
Makes sense.
we have Mr. Colton Kennedy here in the back, who's the new manager of one of the teams that is overseeing these, and Brad Underwood, who could not be here today. Under their leadership, the team has done a phenomenal job. I agree with you. I'm very pleased with this.
And I would just say, as Javier started this, I mean, there's work across the business units and the senior management team on the resource allocation, on the O&M side, on the capital side. Obviously, some great input by a variety of folks on the FPPA conversation that we had today, and the senior management team has been obviously have been involved in this conversation. And so it really is a district-wide kind of approach to make sure we're doing the right thing. So I appreciate that feedback.
Thank you.
Thanks, Eric.
It was carefully thought.
That it, Mick, for finance? That's it. Okay. Move on to nuclear. Tom?
I'm going to turn it over to Mary Fisher.
Could I mention about the nuclear oversight committee too, as far as the meeting that we had, before you get into your deep report, because I think it's a really important thing to note. There were a few of us directors who were present during that time. It was a 2-hour meeting. And I want to give kudos to both Mary, Tim Euling, and Ted Main as far as their leadership in the decommissioning. With this oversight committee, you have 3 men who are, 3, right, that were present there this time, that have previous and experience with decommissioning. We bring them in, and they give a very, very, they're there for about a week or so, or how long are they there?
3 days.
3 days that they're there, looking at different areas and everything. And I just want to say, I'm not going to, I had 5 pages of stuff, and it was all pretty good, but Wayne Norton, who sort of leads it all, and Martin Vertilio, and Barrasso was a new man. But he says he's been there the past 2 years, and he says it's very good project organization. It's impressive, and they've had great integration with Energy Solutions. Energy Solutions person was also there. John Sager was there, giving us input, and I think at the end they said, fairly phenomenal that they said on many other oversight committees, and the other decommissioning projects aren't nearly as successful as what Fort Calhoun has done. So I think that's very important to give kudos to all the employees and everything. They were impressed, you know, like we're right on the top as far as the leaders on decommissioning and doing it the right way. So I want to give kudos to everybody and to pass it on to all the other employees.
Thank you,
Now you
Director
can
McGuire.
take over. I was not going to let that pass.
Well, good, that concludes my report for the DOC. Thank you very much. I do have a few things to report. We have a Nuclear Oversight Committee that does audits throughout the year. I'm pleased to report that they completed their last audit in the past month. That audit was on the Independent Spent Fuel Storage Installation Program that we're putting together. And they concluded that everything was implemented in accordance with Appendix B and our Quality Assurance Topical Report. They did find 8 deficiencies. Typically, those are paperwork deficiencies. I read a few of them here to give you an idea. 2 ISFA CQA records contain illegible content, so somebody's handwriting was not legible. A corrective action item was not initiated in a timely manner. So those are the types of things that when they say it's a deficiency, those are the types of things that they find. We go back and correct all of those, and so their conclusion was that the corrective action program is in compliance, and they had no significant areas of concern. They are also doing external audits. They are auditing our dry fuel storage canister fabrication in Columbiana, high-tech. They continue to go out there and witness the production of those. And they also witnessed the placing of our horizontal storage modules. And I have a few slides to share with you. Christy, if you could bring those up, please. So this slide, I want to indicate to you, if you look at to the left, you see the existing 10 canisters or horizontal storage modules that are on the ISFA pad today, and you see that concrete path that goes out. That concrete path was empty. You can also see on the very end, if we can't really see it on this picture, but on the very end was that end cap that we had to move. Christy, if you go to the next picture. This is what it looks like today. So you can see all of those storage modules have been put in place and ready to receive fuel when we go. And that very, excuse me, end piece is the end cap that's now back in place at the end of all these. One more picture. I said that this saved us literally millions of dollars by doing this evolution of moving the end caps and putting it back in place. You can see here we made it by inches. Had we not made it by inches, we would have had to extend that path out and redesign that pad. And so this is what moving that end cap did for us. One more picture, please. And this is the final product. So all of those canisters that you've seen over the course of the last year being built are now put in place and ready to receive fuel.
This is what the decommissioning people were just praised. There's nothing but praise at the way that this was done. I think it was the first time it ever was done.
The end cap, yeah, removing the end cap and placing it back is the first evolution that's been done in the industry where they've had fuel in the canisters already in those first 10. And so that's never been done before. It was done flawlessly. The team did dry runs on it, planned it for a number of months, and it was really phenomenal work. Thank you, Christy. In other areas to report on, we have filed for a partial release of approximately 120 acres along the easement of the property in Iowa and to the north of the plant. We do that specifically for a couple of reasons. One is that the early release gives us the expertise to go out and to practice some of the things that we're learning. So when we get into final decommissioning and we have to put a final plan together, we're gaining that expertise as we go. And this is on property that has really been undisturbed by OPPD. So it gives us that base and it gives us several learnings. I did want to mention that the NRC has to have a public hearing on this request, and they have announced that that public hearing will be on Wednesday, November 28th, from 7 to 8:30 p.m. at the Residential Inn here in the Old Market. So that will be ongoing later this month,
And we're gonna put that in director's update.
You said November 28th?
November 28th. Last but not least, we are working on what we call legacy large components. These are steam generators that were replaced years and years ago, have been in storage. We're working with our partners, Energy Solutions, to try to start to move some of those large components out. We've really targeted holding off on doing this until we got a lot of expertise in moving these radiological packages out and going to their final resting place, either in Clive, Utah, or going to a reprocessing facility and then going to Clive, Utah. These large components obviously are tricky to get in and out and to move around, and so we wanted to leave these after we've had a couple of years of experience. We think now's the time to do that. So we've taken on that project towards the end of this year and into next year. And then last but not least, we're still working on our decon methodologies, and we have another presentation for the Board of Directors in the closed session. And that concludes my report for nuclear oversight.
Are there any questions for Mary? Just curiosity, so undisturbed 120 acres in Fort Calhoun are an easement across the river,
We have 120 acres on this side of the river. We're also getting rid of a parcel of land. We're releasing that back to, free release it to the public on the other side of the river. We just put in a letter for that yesterday, and we believe that the NRC will address that as part of the public meeting as well.
So, history, help me somebody. So I understand that the property was originally purchased thinking that there might be more units put out there?
Correct.
Is this part of that extent, or did we already downsize it?
No, it's really a buffer area for all of our power plants. We try to have a buffer area around us to make sure that we can conduct our facilities, conduct our operations, and maintain good neighborly relations and relations with the community. So typically, when you start to build a power plant, you want to have a large buffer area around you,
Sure.
so you have enough room to do whatever you might need to do. I will say that Fort Calhoun had 660 acres that we own, OPPD owned land, as a buffer area around the plant. That's pretty typical for a power plant, any kind of power plant. I think the disturbed area runs kind of the 40 to 50 acres, and that's also typical of a power plant. So releasing this 120 acres, it gives us the expertise and the knowledge to do that for the larger project that we have coming. But it also, makes that area available for, whatever OPPD might decide that we need to do with that.
Thanks.
Mary, a quick question. Is that land gonna go up for sale, or what's kind of the transaction that you guys are seeing in the next 2 or 3 years?
I'm looking around the room.
Oh, yeah.
We're gonna put a master plan.
Yeah, so I think what we'll do is, one, we want to get it released, so that's the first step. And then we'll look at what are the highest used options for that land, and what would that look like? And so there are a variety of things that we will look at and then come back to the board with how we would utilize that property in the future.
Okay.
Or part of a master plan.
Correct, yeah.
Well, based on what my grandkids like, I'd suggest a pumpkin patch. They coin money for 2 months every fall.
No, very good. So just to, our plan is outside of the istacy that you just saw in the dry cast storage there, our plan is to bring that whole site to green space over that kind of 10-year horizon, to be able to use it for our own purposes and needs, or for other opportunities, which could be economic development, which could be a number of other different reasons for that area. So we'll come back with a broader master plan on what our thoughts are on that.
Let's just say it won't be going to row crop when we release it.
So it may be right away, it might, but not long-term, so not long-term.
Casino.
So it is a number of months remaining before we would have release of that from the NRC. This public hearing is done in advance of them reviewing it and approving it, and so they want to make sure that they get the public comment on that.
7 a.m. on the 28th,
7 PM.
7 p.m.
Yeah, that's it.
Before we go to public information, we take a short 10-minute break.
Thank you.
The next committee report will be public information, and Ann?
Okay, we're going to discuss environmental stewardship. This is the policy refinement discussion, and if you notice, it's part 3. We've put a lot of work into this. There's a lot of diligence and a lot of rigor on behalf of both the directors plus management, and we really appreciate it. It all started back with our first refinement discussion back in July of 2017. We sort of kicked off the actual discussion and recommendation and development of the policy in April of 2018, all the way through September of 2018. We've had multiple meetings about this. We put it up to board review and discussion with the general board for feedback of the draft that we had provided in the September time period, and had comments on that, and came back in October with public comment that they asked something else as far as adding a specific renewable goal. And now we're coming back after further public comments. And the two things that we're going to discuss today is there any further feedback that would warrant further changes to the policies or additional actions, or are we ready to vote on that recommendation for a vote? So I'm going to have Scott Foch, who's had the patience and rigor to handle this the past 7-8 months, to kick it off for us on this.
Great. Thank you, Director McGuire. It really has been a privilege sitting with the PI committee and being part of that conversation to hear the robust dialogue that's happened in the invitation from the Board for Management to participate equally in that dialogue. I want to show this really more pictorially and not for the words at the moment. I think what this is showing is the changes in the red line policy that emerged through all of the conversations over time. The only thing that we went into the initial conversation with that has stayed here is the black font. The red font reflects the conversations up through the September meeting, or actually the October meeting, and then the green line, which is strive toward a long-term goal of at least 50% of retail energy sales supplied from renewable energy sources, what was added after the committee meeting and put out for public comment and review. So there has been very significant changes proposed to the policy. Obviously important in this process is connecting with the stakeholders to go outside of the building and to understand what those we serve have to say about this particular policy and change in strategic direction. The corporate communications team has done an amazing job, I think, of going out and trying to get a pulse and trying to get feedback. The plus marks here show that from the initial feedback period, where up until last month we had 5 Facebook posts, we added 7 more posts. We added 7 more posts on Twitter, and you can see between the reactions and the clicks and the shares, as well as the engagement, media engagement, likes, retweets, post clicks, there has been some activity around all of this. Also, there were media contacts and multiple articles out there, so there certainly was an opportunity for public awareness to listen, to understand, and to provide feedback. In total, the first period of public comment, I think we had, if I'm doing my math right, we had about 217 comments. And then there have been 49 comments received since October 9th, for a total of 266 public comments. Up to now, this is really the most comments we've received on any of the policies that we've sent out for thoughts or feedback. I think it's also important to put this into context. OPPD serves 365,000 customers, or 800 and some thousand individuals across 13 counties. We have received some engagement, and there's a lot of people from whom we did not receive feedback.
Hey, Scott, do you know were some of those duplicates?
Pardon?
Were some of the comments duplicate?
There was, as you see here, received and reviewed 169 comments. What this was individuals responding. There's 144 of the same comments kind of coming through in that initial. So it was important. It was individuals responding, each individual response. There's 144 that were the same response.
Scott, before you jump.
Yeah.
I appreciate the intent to provide context for not only the volume of what we've received in terms of comments, especially as it relates to any other feedback that we've received on other strategic directives. I think we sort of expected that, it's fair to say.
Yeah.
And as it relates to the total number of customers that we have, I think one thing that we don't articulate here that is important is that there were, I'm not gonna be able to list them, nor can I give you a specific number, but there were several organizations that provided
That's
comments
correct.
that represent dozens, if not hundreds of people. And so I think there's a multiplying factor there, where, 300 comments, whatever it is. I think it's more accurate to suggest that that represents more people than just those 300 people.
That's a great point, and thank you for bringing that up, Director Moody. There were several I know that Director McGuire mentioned, all of the ones up through October 9th during the last committee meeting. And so that is a really great point.
On that too, I do think it's important, the media picked it up.
Yep.
This is
Oh,
covered
yeah.
up quite a bit, so that's good for all of us to see the media picking it up, and then if we're getting any feedback from, when you're out and about, so that's a good thing.
And to add to that, the team did a really good job of proactively keeping it front and center and so forth for that response as well. And we did receive some responses from people that were not OPPD customers as well, but we honored that as well at this time.
And I think just to keep it in perspective, what do we have, 365,000 households, 800 and some thousand customers? So several hundred responses against that is a very tiny percentage. I just want to keep that perspective out there also, Craig.
But I think there really was an interest in this,
Oh, yeah.
I think there was an interest in our climate and the environment and our environmental responsibility, and I think that's why we got a lot of it.
Yeah, I would add that, and I appreciate those numbers bear themselves out. And there's no doubt that, let's just say it multiplies up to 600 or 700, whatever it is. It's a small percentage of the total. I think the other thing that at least I know some of us did, the PI committee, has looked at what are the other broader national trends around perspectives as it relates to utilities and environmental stewardship. So it wasn't just about what are we hearing from this small percentage of our customers. It's about looking at the broader picture of what else is happening around us.
Which is the right perspective to have.
And I think what we typically get from our customers and the research that we do is that they trust us to do the right thing. We hear that over and over again, right? So they trust us to do the right thing, which I think is just a good indication that, we do pick up those, whether they're national trends, regional trends, local trends, comments, perspectives, but at the end of the day, they trust us to do the right thing. So, and we typically see that in most research that we do. We just trust you to do the right thing.
And we have constant communication as well with those organizations, which I will tell you, it was so nice because they wanted their voices to be heard, and we did that. But they also said, let's bring it all together as well, so it's a voice for the environmental stewardship portion of it. So we do appreciate that relationship greatly.
I think in facilitating the process and just in summary of the conversation here, there was a confluence of factors that kind of brought to bear in terms of shaping the overall policy revision, and certainly the voice of customers, everyone, was read and reviewed and was brought to bear in consideration for the formation of policy revision. So.
And to Mark's point, it's more than fair to say that the vast majority of customers just want their power to turn on. They aren't interested in environmental issues, whether you or we agree with that. It's about the rates, and it's about turning the lights on. That's it. It's a very simple formula. Now I think this is a great process, and I think you've wordsmithed this thing, I think, a lot. Generally, it's very nice, and we all want environmental stewardship, but never discount that people generally don't care where their electricity comes from. They want it to work, and they want it cheap.
And to add to that, back in 2014, when we did our resource planning, we went and asked the public, and we had multiple things in, multiple times that people came in. And the top 3 things were, first of all, rates, reliability, but the third thing was environmental stewardship, and they were willing to spend money on renewable and sustainable resources. They said up to maybe 3%.
Yeah.
So I think that's, you know, so with those three things. is
But
what
not
they-
all people, that was those
Not all
that
people.
chose to, if they would take renewables and be willing to spend 3% more.
Yes.
But generally, people just keep my rates low and
It's the first two
make
things
sure
that
they
are most
work,
important.
right.
Yeah, but the third thing was environmental
Right.
stewardship.
The general themes and considerations that came out from all of the feedback, these did not change, but I think it's important for today's conversation to just reiterate what they were and the volume around them. The first bullet really around establishing a vision for a 100% renewable energy, carbon-free future, and to keep renewable energy sales target. This was by far the loudest bullet through all of the comments that were received. There was also a lot of conversation around including reduction targets for other air pollutants such as nitrogen oxide, sulfur dioxide, mercury, and carbon dioxide. And there was also many comments around including annual total metric tons carbon emissions. On the right side, there was kind of a shift, if you will, just a little bit from the strong focus on renewable, and that was talking about the importance of reliability and resiliency are important considerations. I think that gets to your point, Director Mines. Energy sources should provide certainty and flexibility, and balance of affordability, reliability, and sustainability is important. Again, by far, most of the comments were characterized in the first three bullets, and some other bullets did emerge showing that balanced perspective. Any question around the comments?
Yeah, I'd like to ask if this board were to say, okay, we want to be 100% renewable in 10 years, what does that do? What does that do to our model? What does it cost? How do we get there? I mean, from my perspective, that's totally unreachable.
That's why we had a lot of discussion on that.
Yeah.
The past things, and when we discussed exactly how we met our suggestions as far as action, why we didn't think that was possible, is what we have. Yeah.
So,
Good point. We'll
okay,
discuss
so
that.
we're
We're
not
gonna-
going there.
no, we're not going there. We're gonna go, you'll see where we're gonna go in our draft policy.
Okay.
And why we did that,
Yeah.
as far as realistic solutions.
So
I
if you,
keep
hold on a
seeing that
moment, yeah.
100% come up, and we
Yeah.
all want 100%, but it's unreachable.
Although,
At this stage,
I mean,
we'll talk about this.
but we went there. I mean, can't.
Oh, yeah.
And that's not the recommendation. You're gonna see in a minute.
We discussed it in detail.
But that was a big part of the discussion.
Huge part of the
I
discussion.
don't know, do we want to even discuss it or whatever? I mean, yeah, it's a different model, but anyway, we didn't go there, but we talked about it, if that's what you're
Can we go
getting at.
there?
Well, we'll
Go wherever
talk
you
about
want.
it.
That's why we bring them here to
Yeah,
this.
we're gonna talk
Okay.
about that as we go to the
But,
numbers.
yeah,
I mean-
I think that will be brought up along the way.
Yeah, along the way.
Okay.
That's gonna be a big discussion. I think what's important, though, is the first paragraph on this draft policy. We spent a lot of time on this, the first paragraph, and I wanna spend some time, if you could read it, and then we could discuss it, Scott.
I'll just, what I'll do is I'll just go.
you can keep it as a placeholder and bring us back.
We'll have it.
What does that mean?
We'll talk about it.
We'll go with her
Oh,
flow,
I see.
and then if you,
Okay.
yeah, yeah.
We
Okay.
gotta talk about this first paragraph, because this is really what our policy is, right?
If you'd indulge me for a moment, I'll just read through the policy in its entirety so that you can hear. And what I'll do is I'll come back to the first paragraph, and then we can have a moment to talk about the Public Information Committee perspective on each, and then open it up for board discussion on each, if that works. So the proposed policy right now for board discussion is managing its interactions with the environment is essential to OPPD's ability to serve customers, create value for stakeholders, and contribute to the well-being of its employees and communities it serves. OPPD, good timing. OPPD is committed to operate in an environmentally responsible manner and to strive for the continuous improvement of its environmental performance. Therefore, OPPD shall conduct its business in a manner that at a minimum meets all environmental regulatory standards. Demonstrate accountability and transparency by measuring and reporting its environmental performance in support of applicable regulatory standards. Pursue a long-term goal of 20% reduction in carbon intensity from 2010 through 2030 as measured by the Climate Registry Electric Power Sector Protocol. Strive toward a long-term goal of at least 50% of retail energy sales supplied from renewable energy sources. Develop and deliver innovative energy products, programs, and services that help customers achieve their environmental goals. Participate and provide leadership in the development of national, state, and regional environmental policies and initiatives that support OPPD's mission. And manage internal operations to promote the efficient use of resources and minimize environmental impact. And I know, Director, you are anxious to talk about the first paragraph, so I will turn it over to you for initial comment from PI Committee.
Yeah, thank you very much. I really love that first sentence, that we realize, the entire company and the directors realize that we have to manage the interactions with the environment, as far as what OPPD is doing. We recognize that we can, in fact, affect the environment. And we want to create value for the stakeholders and contribute to the well-being of the employees and the communities it serves.
What's the definition of a stakeholder? I've heard stakeholders used in these discussions as special interest groups, as even other industry concerns. Who is a stakeholder beyond our customer?
Ratepayers, maybe it should be.
Beyond our
In my
customers.
mind, I think we were talking about all the ratepayers in our
Yeah.
OPPD footprint. Stakeholders seems to be the catch-all.
Employees.
We've defined employees, the well-being
I
of
mean,
our
it's
employees.
anybody who we touch. Vendors.
Sure.
National associations
Sure.
I mean,
They're a
in my
stakeholder.
opinion, the ultimate stakeholder
is our
is
customer.
our board. We're the stakeholders.
We're stakeholders.
That's true.
It's
There
very
is a
broad.
definition,
I think it's
if I
ratepayers
recall, I don't have it in front of
It is
me.
great.
Yeah.
But there is a definition, if I recall, in the glossary of the policy manual around stakeholders.
Oh, I apologize.
I believe that's to be true. I know it's been an ongoing conversation.
Chris is going to validate that. Sorry, I'm giving you the knife
Hold,
hand.
please. Stakeholders in the glossary, it's customer owners, employees, community leaders, media, retirees, and any other person of interest or concern regarding OPPD business matters.
So it's any other person,
it's-
anywhere, anytime?
Yep. Everybody.
It's a little broad, if you ask me, but, okay.
It's a pretty typical term, though.
Yeah.
Even includes Putin.
Putin is a stakeholder.
But I want to look
later.
at well-being, that well-being.
He owns natural
includes-
gas.
I think well-being includes, health, safety, and, the feeling of well-being. I think that's important to be in there, that we recognize that we have a responsibility there.
I think it's a very well-crafted opening paragraph.
Any other comments or reflections from the PI committee or from other board members?
Other than committed to operate in an environmentally responsible manner
Are you just talking
and
on,
strive for continuous improvement. And that means with decreasing, we didn't specifically state emissions or anything, what emissions we're decreasing as far as NOx, but strive to continuously improve the environmental performance.
yeah.
And that would go into number one.
And I think so to your earlier question, Director Mines, was, what is 100%? That was definitely brought up. This seemed to be a compromise between those who feel extremely strong about carbon emissions, renewables, whatever. So I think it was a compromise on a lot of these things. which I think is a good thing, quite honestly. Extremism or a little bit,
Well, we have to worry about rates and reliability.
yeah, but, for sure, and that's what the compromise is about.
That's
You
right.
gotta keep the lights on, and people don't wanna pay a
It's
fortune
not
for
really
this.
compromises, what's
So,
going to be done, yeah.
that 50% renewables was put in this third time because part of it was, if we get rid of renewables, people would say, well, gosh, what happened to renewables? I mean, you've been doing that all. So it's something general public can understand, but then adding the carbon intensity, that measure is, I'll let someone who knows a little bit more about that explain that
Yeah, there
part
was
of it.
blowback at the last meeting about,
Yeah.
I
how does
think
that
Could we,
affect our
could we get
rates?
to processing?
if I
that?
could,
We can
it'd
talk
be,
about
it's gonna be
that. Let's go
easier, I
back
think,
to
to go this
one
one at a
bullet by
time and
bullet
get
we
a
need to go
sense or
by.
a feeling for where we are. Is there any other comments on the first
Yeah,
paragraph?
as I've read it, we had a PI meeting yesterday, and we're tinkering with the little language that we ended up setting aside. And one of the words that we were kind of wringing our hands over was this idea of continually improving. And it was specific to, it wasn't a broad continually improve, it was specific to something that we were talking about. And I guess I'm just kind of curious about, we've got continuous improvement of its environmental performance in the preamble here, and I want to make sure that those that had concerns with the need to, or those that had concerns with this idea of continual improvement don't have the same concerns here. No?
So management and feedback.
To demonstrate continuously improving on many different
On
variables that
broad
aim
array
there.
of things, okay.
The issue I expressed, and some of my colleagues expressed, was when we narrowed the continuously improving on a specific target.
Yep.
That's where we were a little more present to that change, because even though we all are aiming to improving on all of these variables that were discussed during these meetings, continuously improving had the connotation of every single minute or every single
Yes.
month
Yep.
or every single year, and because of the nature of our system and the complexity, we may not be able to hit that every single year. It might be a longer term improvement.
Yeah, okay, all right.
Yeah, and the best example that Mary Fisher gave was about, as far as the next year our plants, you know, Nebraska City is gonna go down as far as maintenance, so our carbon, you know, amounts, emissions, and intensity would decrease, but the emissions would decrease, but the next year would go up. So that wouldn't be a continuous decrease, and we'd be in noncompliance to that.
Correct. And the other thing I would add to what Javier said is that when you say continuous improvement of its environmental performance, to me, that's a broader perspective, right? It brings in things like recycling. It brings in what we've done in terms of the monarch habitats. It brings in a lot of different parameters. When we try to narrow that down, I think we get focused on just one parameter or two parameters, or in this case, three, as some of the comments came in. And really what we're trying to do is to strive to do better overall performance for the entire company.
Any other comments
Great comment.
on the first paragraph?
Well, we're still in the first paragraph.
We are.
Stick with the first paragraph for a minute. When companies broadly look at ISO 14,000, some kind of standard on environmental performance, they talk about environmental impact from the things that they do. So this first paragraph doesn't have any measures that are tied back to it. And to your point about the monarchs, what is it that OPPD does that harms the habitat? And so to me, there needs to be a connection between the harm that we do to the environment and the benefit that we give it. There should be some recognition that, you know, that our activities have an impact. What is it? How big is it? And when we claim to be doing something good, then it's to reduce our impact.
So I don't believe that in order to be, strive for better environmental performance, that we necessarily have to impact in this case, if you're talking about the monarchs, we didn't impact their habitat. What we did was provide a better habitat for them as they migrate through. So I don't think that if we're striving to do better environmental performance as a company, it doesn't necessarily have to be tied to any impact that we had. Obviously, as we produce electricity, we have an impact on the environment. That is true. We all know that to be true, which is why we have the Environmental Protection Agency, which is why we have regulations, which is why we say we are striving to meet those regulations, and not only meet them, but meet them as a minimum and do more to strive to have good environmental performance. And as this states, it's a continuous improvement of that. In the monitoring report that we gave earlier this year, I talked about the low emitter status that had been attained at Nebraska City 2. What that means is we're driving our NOx, our nitrous oxide emissions, down to a level that is 50% below what the regulation requires. We're doing that voluntarily. It's not tied to anything. It's how we're striving to improve the environmental performance of the company. We're doing that on all of our coal-fired units. Each one is in a different stage. NC1, should it continue, and I hope it will, has met 11 out of 12 quarters. The 12th quarter will come early next year. It too will attain that status. It's not something that I think is necessarily tied to any impact that we have. I think it's tied to our feeling that from an environmental performance as a utility company, we should strive to do the best we can. So we do the things that we can. We do the things that we can do in order to maintain performance, maintain serving our load, maintain customer service, maintain rates, all of these things that the board gives to us in SDs. We strive to balance all of those to come to, can we do better in an environmental perspective? And the answer is yes. And the answer is we are doing that. What we know we can do, we are definitely taking those steps to do.
And I think in the basis of this, I mean, so as this draft policy, if the board accepts it, is given to management, then it is up to us to demonstrate to you that we're showing continuous improvement in our environmental performance. And you as a board get to determine whether or not we're meeting that, we're meeting the standard that has been set by this directive, or we haven't, right? And so we would take this policy and begin to think about ways in which we can, even beyond what Mary talked about today, improve our environmental performance and what that would look like, whether it be internally, externally, whether it be with our employees, with our customers, with whatever that may look like. We would begin to craft strategies and initiatives around that.
Or technology development, right?
Sure.
We pay attention to that as well.
Tim, one thing, when you say we would begin to, I think that's, we are already been doing that all
Sure.
along. So
That's correct.
this is just redefining it for you. Here's move the goal a little further out. But these are things you do every single day.
I would agree with
So,
that.
yeah, I mean, at some point, I don't think we need to say these are the bad things.
From 2010 to 2017, our CO2 production is down 8%. So, I mean, that's not required by law. And so total tonnage has gone down. Well done.
Good thing, yeah.
Any other comments on the first paragraph?
You know what, I just had a question. I said, I've always gone into with the strategic directors as being guardrails.
Yeah.
It's not as they're hoped for that we can meet them. But you're taking a situation where you're looking into an auditorium through a keyhole, and you're staring at a renewable booth, and there's an entire auditorium that has reliability, employees, cost increases, cost decreases that you don't even see. So I think it's to take a minority view on, I'm all for renewable energy, and I'd love to be 100, but it's not there. And let's be completely honest, there's no industrial battery backup. There's, with wind, in the summer, the wind doesn't blow. We can go days without sun, and if you look at any natural thing on solar power, we're in the eastern end of the state. We're at the low end of the scale for solar power. So let's just be completely honest. And these strategic directives should be looked at every 2 years or a certain thing and changed as the market advances or decreases or expands or contracts. Right now it seems like we're a bunch of cancer doctors, and if we don't get this right, the patient's going to die. It's just the intensity level between a segment is just pretty tense. And these are directives that are living, breathing deals, and you look at them and you make changes as you can. I think it's just wrong-headed to say we want to be this. You're sailing to an island you don't even know exists. Are you sailing across a lake or an ocean or a river? You don't even know that. You're just trying to get to some point. That's a figment. So that's me.
Good comment.
Shall I move to the second paragraph? The next one, therefore, OPPD shall, conduct its business in a manner that, at a minimum, meets all environmental regulatory standards. Any comments from the PI committee regarding this bullet?
Even though that's a short sentence, there was at least a meeting or two on that discussion. And again, that was whether or not we have specific standards set or whatever, meetings for NOx, SOx, mercury, other environmental standards too that are in general we wanted to put in. So this is a more broad, and the word minimum there is that we already meet the standards, but we want to, even improve on that. And Mary already gave an example of that, of how you're exceeding those standards.
Well, obviously, we have to do that, regardless.
Yeah,
of
we
policy.
have to do that, but we want to
Okay, it's in writing,
exceed
so
that.
good. We feel good now.
Yeah.
Fine.
Just to be clear, we don't have to be a low emitter status. That's an option.
No, the low
And that
emitter
is
status
something that we're
an
driving to
addition.
do, as part of our commitment to the environment.
So, a year ago, I think I mentioned the term beyond compliance, and Tim was quick to say, hey, we're beyond compliance. This Tim. And certainly, you are showing many times when you are doing that. So, Director Kavanaugh, when you say, well, we got to do that, and so we feel good about it, I would feel better if we would encourage more beyond compliance. And so I tried a different way of saying it. It didn't come out, wasn't taken. But I'm proud of the company for doing that. I think people are working hard to do that, and it's not easy to do. And that's where I am.
I'm sure we'll exceed many of the minimums regardless.
This defines it because it used to read, conduct its business in a manner that meets all environmental regulatory
Right.
standards. We added at
At
a
a
minimum.
minimum, yes.
So you can excel and try to
We
do
want
better.
to excel in that,
So that
yes.
was a
We want to go,
change.
beyond compliance would be
Yeah.
part of that, yes.
Any other comments or reflections? Third bullet, pursue a long-term goal of 20% reduction in carbon intensity from 2010 through 2030 as measured by the Climate Registry
skip one?
Electric.
You skip
Oh,
one.
demonstrate accountability and transparency, by measuring and reporting its environmental performance in support of applicable regulatory standards. Any initial comments from the PI committee?
I think Russ Baker for that.
Opening it up then for full comment.
Well, yeah, so that's a good thing. Making the numbers more accessible to the public would be useful.
And we're working on that.
Louder, please.
And we're working on that in terms of the website and so forth, so.
That's why we have that there. We want to work on that. That's a policy that we want to increase the transparency.
All the numbers are available, but what you're saying is make it easier to find that
Easier to
information.
find
So
it.
that's what the team is working on.
Yes.
I don't think anybody disagrees with that.
Any other?
Go on.
Third, pursue a long-term goal of 20% reduction in carbon intensity from 2010 through 2030, as measured by the Climate Registry Electric Power Sector Protocol.
Okay,
Yeah.
this was about 3 PI meetings, which took quite a while. That's about 6 hours of everyone's time. Craig, you want to comment on that one?
Sure. So let me ask a question first. So I think maybe 2 meetings ago, I asked if we have any data around where other utilities are, and I think the answer was no, not currently. Is that right? I mean, it's all publicly available data. We just haven't aggregated it and looked at sort of how we compare. Is that fair?
It's hard to do.
It's not hard to do because.
I mean, with the size, I mean, as far as apples to apples, oranges.
In what regard, Director Moody, would you say?
So part of what I'm curious about is Rick has done a really good job of pointing me to resources that show how other utilities are measuring their environmental performance. And more often than not, correct me if I'm wrong, they're measuring that in terms of gross carbon emissions in a year. So it's just total emissions. So there's a standard there that we can kind of look to and measure ourselves against. It doesn't, in the way that intensity gets you sort of wrapped around size, in the same way that you would measure a building's energy per square foot, right? So I'm just curious about this number and whether or not we're really just only measuring against ourselves, or if there's anything around us that helps us understand how we compare. The percent of retail that's renewable, everybody's got a number out there, right?
That's correct.
And so we can look at that. I just don't know the extent to which our carbon intensity number is something that's commonly discussed in the electric utility sector, and if we know kind of how we shake out versus any of our peers.
That's a great question, and I appreciate the context for it too, Director Moody. Many people don't advertise or outwardly, proactively provide that kind of information. I think most people, and it's probably from an ease of understanding, which we've had many discussions about that. They look at a percent renewable goal, typically is what they're looking at. But there are, well, every utility actually has to report all of its greenhouse gas emissions, and they're also reporting what their generation capability is. So they're in fact providing the data that would do a carbon intensity metric, and using the Climate Registry Electric Power Sector Protocol, there are many municipalities and many utilities that are also using that protocol to account for those emissions and then transform that into a number that can be used from a carbon intensity factor. So what I would say is you probably don't hear, it's not maybe publicized as much that they're doing it, but that information is available. They are reporting on it. We are reporting on it regardless. And I think again, as I've stated before, using a carbon intensity factor allows any utility, to be able to present information, I think, that will help its customer owners or its stakeholders, that we talked about, better understand what their entire generation fleet is, factoring in carbon as a portion of that as well. So they do have a lot of data on that. They're probably just not publicizing it and promoting it in a way I think that we're suggesting that we could do, if that answers your question.
The only thing that I would add is that the 20% reduction was not an arbitrary number, right? It was based on what we would have, what would have been required to do as part of the Clean Power Plan. So we used that as a basis to drive this number. And our thinking around that was that if EPA was regulating a Clean Power Plan and they thought that that was where we needed to be, then we wanted to make sure that we had put plans in place to meet that by the year 2030, based on what was in the Clean Power Plan. So this is consistent and would have, if that was still in effect, if the Clean Power Plan was still in effect, we would have met the requirements of the Clean Power Plan. So that was the basis of the number.
So carbon intensity was the goal for, within the Clean Power Plan?
It was. So as you'll recall, there were two approaches that a state could take. You could do mass reductions in CO2, straightforward, or you could also look at your rate of generation of CO2, and you could manage it accordingly. And I think what this metric does is kind of represent that in a manner, I think that, as Mary just suggested, correlates very well with kind of a 2030 Clean Power Plan approach to electric generation.
And the overall goal of the Clean Power Plan, of course, was to reduce total carbon nationally, not carbon intensity.
Correct, but I would say, taking it one step further, reducing the carbon is going to reduce the carbon intensity across your generating fleet. Reducing the carbon on a static portfolio of generation options, reducing the carbon, or providing more power output by something that's non-carbon generating will reduce that intensity. It just will.
Fair statement. It's a longer statement, but it's a fair statement.
Okay, thank you.
I'm sorry, I felt like I interrupted you.
Nope, you didn't.
Okay. So I, yeah, maybe you didn't want to sit down. Or maybe you did, I don't know. So I put together a graph, actually I amended a graph that was put together by Vice President Fisher and Russ Baker, so I'm not sure who the author was, but it got it from the both of you. Is that something that we can show?
It's not up there right now.
It's in the resource
It's in
center.
the Resource Center in Diligent.
Yeah. So, but so I can give some numbers, it's just, I think, a lot more powerful when you can see the visual. So to the difference between intensity and total emissions is that carbon intensity, the way the language is given here, we talk about a carbon intensity reduction. And the graph shows that in our history from 2010 to 2017, in fact, intensity has gone up a couple of times over that 7-year period. It's gone up while the total carbon has gone down. 2011 to 2012, it went up and total carbon went down. 2012 to 2013, it stayed flat, carbon intensity stayed flat, and total carbon went up. So these measure different things. And I'm uncomfortable with a measure that is ambiguous and does not accurately reflect our performance by itself. That makes sense? I think it's incumbent on us as board members to give numbers and measures that are understandable to the public and are not ambiguous in what could be happening at OPPD. And that's why, one more thing, when we look at these standards that our other utilities use, they report not only carbon intensity, but they also report total carbon. Because with those two numbers, you can calculate. And that's in fact what people do with the carbon registry stuff. They're, yes, utility, that's where I got my electricity. And as I report to my shareholders, as I report to other businesses, as I try to hire people, this was our carbon footprint, because they have those two numbers. And so this number alone makes me uncomfortable because it presents an ambiguous situation. I think the public trust that we as elected officials have is to speak clearly and honestly about the issue. And this number alone does not do that.
I have a question. I think at this point, Director Yoder and Director Modi, what is your ultimate goal? I mean, you do this voice dance, and you're spending a lot of time and a lot of emotion. What's your ultimate goal? What do you want SD7 to look like? Because you seem to be operating on a higher, on a different level than the ratepayers and the stakeholders and everybody else. What is your goal? It's just it's getting to be a little bit frustrating because you throw out terms and equations and stuff that I haven't heard, and so it seems that your expertise is just you just want to keep talking, but you tell us what your goal is for SD7.
Sure. I would have two. For this particular line, it is that anyone who hears from the board what our environmental stewardship is relative to carbon emissions understands what our emissions are year over year, that we're making progress. This measure alone does not do that. It needs two measures. And actually, Director Trinan, when we first brought this up in committee, that's what you asked across the table. Hey, if we added a total with it too, would that be okay? And it would be okay for me.
Would it be unreasonable, since this is in the form of a resolution, that we be fully briefed on the actual entire resolution? And then if anyone has any concerns with specific clauses, paragraphs, what have you, in the resolution, they could propose an amendment to the resolution on Thursday, and we could vote on that amendment. They should.
Good idea. I think that's a good idea.
I think that would keep things a little bit more
On track, yeah.
Well, hold on, the only reason I
Well,
would
hold
not
on, we
do
did have
that-
some more comments, so go ahead, Greg.
Well, I mean, there's been hundreds of hours, and I'm not
Oh, I
exaggerating when I
should've-
say
I should've
hundreds of
think that was
hours
the same
hours.
from senior management and the committee doing this. And we discussed these things, Director Barrett brought up, we discussed these things just yesterday, and the committee voted against that, and to come with this proposal, because it was much more aggressive on some of these goals that Director Yoder proposed to the committee, and they were not adopted, all right? So that brings us to where we're at today. I think on this deal, in response to you, Director Yoder, Mary Fisher brought up a point that struck my memory. Back on one of the first meetings we had, the only reason this is in here, this 20% was picked, I think, because that was the clean power
It's a
plan.
clean power.
And I said at that point, at this point, why would we even bother with that? We have a new administration, you know, whatever. But, however, history has a way of repeating itself, and these things come back in a whipsaw. So let's say the current administration isn't around in 2 years, or whatever, and a new one comes in, we'll be right back to this. And if we haven't prepared for it at all, we're gonna be in trouble. So, as a compromise, we said, what could we work with, senior management? And they put all this time and effort into this, and this is where we came up with that number. So it's not just randomly thought out. This was best minds in the country who thought this was a good idea with this number. That's why we're using it. Now, you don't believe that's correct, but that's how we got to the number. And if I'm wrong, correct
No,
me.
you're absolutely correct. And it's not like we're not going to be reporting carbon emissions. We are going to be reporting carbon emissions as part of the first bullet and this bullet. We're going to be reporting two of them. But this is what the Clean Power Plan suggested. I think there's common sense about it. Mary has gone through multiple hours explaining the same reason why she wants intensity versus emissions. We are still going to be reporting emissions in this.
I agree with the chairman. The committee has made a recommendation. It's on the agenda. If anybody wants to make amendments Thursday, offer them, and we vote on those, and we move forward. It's the way it should work.
Yep. Okay, should we go on to the next bullet?
Well, hold on, let me just, because I was asked a question, I'd like to respond to Director Barrett's inquiry. So I want to offer a couple thoughts. First, I want to echo what you've said a couple times. This is a compromise, right? So to that point and to your question, and I said this yesterday, I've said it publicly, and I'm going to repeat it again. My view is that, to Director Yoder's point, I'm very focused on what is our biggest impact environmentally speaking, and to me, that's carbon emissions. So I'm very focused on that as sort of what our environmental stewardship directive should guide us towards. And when I think about that, I'm thinking in very long-term directive terms to get to at or near zero carbon emissions. And I'm not talking about 2030, I'm talking about many, many years down the road from that. And what I'm most interested in is for us to be thinking about what that future looks like. We don't know the answer to that. To your point, Director Barrett, we don't know. 100% by 2025, 2023, we don't know how to get there. We don't know. The technology's not there. We're not prepared to put that on our ratepayers today. There are multiple reasons why that short term doesn't make sense today. Be that as it may, when I think about this directive, what was most important to me was to really push us towards looking towards a long-term future where we're driving down carbon emissions. And when we talked as a group, whether you measure that by total gross emissions or a CO2 per megawatt hour index, the equation nets out to zero either way. So that's why I'm not super concerned. I'd prefer gross emissions. I agree with you on that. I'm willing to relent and compromise on that. That's fine. Because to me, I think the broader point, and I think the general understanding is that we want to continue to drive that number down. Period, full stop. Now, how we do that, how quickly, is really kind of where the rubber meets the road. But for me, it's really that long-term vision. This doesn't articulate it in a way that I would like. That's okay. We've reached a compromise. I'm happy to move on. But to answer your question, to me, that's what's most important.
Carbon emissions. Okay.
Thank you.
I said I
Director
had two
Kavanaugh,
concerns.
as board chair, I think you've asked that the discussion process be accelerated a bit versus going bullet to bullet.
I would appreciate that. This is certainly a committee report, but I'm not the chairman of the committee.
Yeah,
But
I would like
certainly
to
my-
go
Director
on to the next,
McGuire.
I would like to read the next 4 bullets, and then we can go on and discuss about whether or not this would be an action item or not.
Thank you. So the next bullet, strive toward a long-term goal of at least 50% of retail energy sales supplied from renewable energy sources.
This is what was brought up last month, and that we got feedback from. I think some people still wanted 100%, but I think I'm comfortable with the 50% retail energy. I think, again, it's going to be a stretch for management as we increase load, but
We have public feedback on this at 100%, and it seemed over and over and over again at 100%. But yet, the compromise, I think, was 50% is not a slam dunk, and everyone thinks this 50% is some slam dunk. It's not. 100% is misleading if you just want to.
Unattainable.
It's unattainable at this point,
Today.
absolutely. So I think, again, the compromise was 50%. It's a goal, it's attainable, but it's not just some number to appease somebody.
it is a number that changes as we increase load too.
I think we heard in the corporate operating plan, we're seeing an increase in load in 2019 that we didn't see in 2018. Now, some of that has to do in 18 with weather, but this is really about revenue growth, load growth, and so that 50% will continually change, right? It'll continually grow as that load, as sales grow. So there is an expansion to this that isn't finite. It is, we don't get to 50 and freeze at 50, right? Because that will continue to grow, assuming we continue to see that growth in our service territory within our region as well.
And as much input from senior management too, I would say, on this particular point, to get to this number.
Yeah.
And I think the balancing act here is growing this number while maintaining reliability.
Absolutely.
Sure.
Okay, because that's the key.
Exactly. As far as transmission and everything else, it's a big picture. We asked with SPP too.
And just real quickly, I'm reading from the management letter in our 2019 corporate operating plan, there's a hefty
Right.
paragraph on renewable energy, and the last sentence, we anticipate this renewable metric will grow considerably in the coming years with new and improved technologies.
Right.
So that's after referencing the fact that we're gonna be at 40% by the end of next year.
Right.
So 50% is planned, it's in there, we've talked about that as sort of a goal previously, so that's one of the reasons why it was kind of, I was struggling with how squishy that was, is because in our IRP, we had sort of planned to get there already, with some of this new growth that we're seeing. A lot of that got set aside, we're reevaluating what our generation plans are, so 50% is, to me, a good compromise, it's appropriate, it's, we're gonna have to push to get it, which is good, but I'm happy with it for now.
Historically, it's interesting to think of a goal from 10 to 30 to 50. There's been 20% increments between each.
It's
and
not
the
really 20%,
organization has
it's
continued to
40 to
drop.
50, for instance, is 25%.
Pardon?
It's not really, it is significant, isn't it? It's 50% is significant, that's a
Yeah.
25% increase,
Yeah.
not 10%.
Yes, yeah. But going from 10%
Going from
to
10% to
30%
50%.
to 50% is what I'm saying historically has happened. So there's a 20% change, 20% point change between each of those. So who knows what's next, to your point, but the reality is for the foreseeable future to aim at 50, I think, was the compromise that emerged out of the PI committee discussion.
Next line.
Develop and deliver innovative energy products, programs, and services that help customers achieve their environmental goals. If I may, I think one of the things that was an interesting reflection from the PI committee discussion was making this connecting customers and their environmental goals, regardless of what those goals might be. So this was an opportunity to continue to promote energy services and solutions that help the customers directly meet their goals. Any thoughts from the PI committee on this? From anyone else? Participate and provide leadership in the development of national, state, and regional environmental policies and initiatives that support OPPD's mission. Any comment? And finally, manage internal operations to promote the efficient use of resources and minimize environmental impact. Again, I would compare and contrast with the last policy, but as you saw, the red line versus the green versus the black, there's really kind of no point. This is a full rewrite, so. Any other comments? Questions? Director McGuire, your thoughts on what next steps are?
My thought for the next steps is the committee recommends that we move forward with an action item on this on Thursday.
Based on a lot of time and effort went into this. The board members that are around the table right now have listened to these arguments. If they, as Director Barrett said, these are guardrails. We look at them every year. I think this is a big, nice change. And then if they want to be changed later, a year down the road, 2 years down the road, whatever. But you've all been sitting around understanding this last 3-4 months, and we've had hundreds and hundreds of hours literally into
Many
this.
hours.
I'd like to I agree with Director McGuire, let's move on and get something done.
And I want to thank the management team. Every management person was there, except maybe Mart was not present at these meetings. And a lot of time and effort was put in for these meetings.
I'm good to go.
Okay, it will be an action item. Christie, put it on.
I got it.
Okay.
Nope.
Items,
No other
is that it
items.
for, information? Okay, next item, the next committee report will be systems management. Rick?
Yeah, thanks for that, and I will turn it first over to Mr. Vi.
All right, this first contract that we're going to discuss is an award for overhead distribution upgrades and rebuild work predominantly in our rural areas. We're really here to kind of discuss a clarification. The contract was already approved in the April board. The original board documents focused on the RFP award in the first year of the contract, which again was approved. Unfortunately, the verbiage did not focus on the fact that there was 4 one-year extension options with this contract. So nothing's changed there. It's just we need to highlight that there are extension options and kind of walk through that.
So is this year 2 of 5, Troy, you know?
So this would be, so we have 1 year, this would be for next year, and then the ability to re-up after that, so, yes.
Nellie Myers has been with us for many, many years.
We've used them on several different projects over the years, yes. Very competent. The work has been very satisfactory, which is why we're looking to extend it. We validate the work that's done in the field. We feel very good with this organization and want to continue that relationship. The contract, just for some context, is they had the lowest bid, lowest and best bid when we went through the RFP process. And this particular contract really focuses on system improvements, pole replacements, reconductoring, things of that nature, customer growth. And they also help aid with storm restoration. So, for instance, they came in and helped with the last storm that we had here in October. And so really what we're doing is asking the board to authorize management to extend the L.E. Myers contract into 19 and for the ability to have 3 additional 1-year renewable terms as long as we feel that the company is continuing to perform adequately.
So your question then for the option years 2 through 4 is how it's stated.
Mm-hmm.
Hey, Troy, just out of curiosity, how do you determine whether the cost is a good deal or not? It's so fluid as far as what we're going to use them for during that period of time, depending on the amount of construction we have, depending upon weather issues and so forth. How do we determine what we're going to pay them? I mean, you use different personnel there for different things, and it's going to be very hard to.
It's defined in the contract. So when we went out, we said, so this is what the work looks like, and this is the cost associated. So if we ramp up and down the work, we know what that cost will be.
Kind of an outsourcing agreement.
Use as needed, kind of.
Yeah.
Right.
Force multiplier.
Exactly. Thank you, Director Trinan. Let's switch over. Stand by, please, Troy. Ms. Fisher.
Thank you.
Yeah.
Thank you. I have a request here for the Board of Directors on Nebraska City Units 1 and 2 to change out our furnace water cleaning system. The system has been in place for over 9 years. We're seeing significant degradation and maintenance, high maintenance. This is critical to our boiler and the health of our boiler to ensure that we can clean it appropriately. And what we see is that the water cannons that are being used today are impinging on our metal and causing quench cracking. So we've gone out for bid. As part of that bid, the current system was provided by Clyde Bergerman. They offered a bid on this that was legally non-responsive, as determined by our friends at Fraser Stryker. And so we are proposing that we go with a Babcock and Wilcox design and change out these water cannons both in NC1 and NC2. Babcock and Wilcox gave us an estimate of $1,288,100, so $1,288,100 against an engineer's estimate of $1,425,000. So they were under the estimate, our internal estimate for this work.
So this is a new vendor? Is that correct?
This will be a new vendor. In actuality, the Clyde Bergerman that we have in there today are the ones that we're having issues with. So we're excited to get these in. We think the design will help mitigate some of the concerns that we have going on within the boiler today.
Right. And as Director Trinan noted during the Systems Committee call, this is an aggressive environment. It's certainly, they take a beating. It's critical because heat transfer depends on the amount of buildup. So,
Right.
yeah.
Yeah, what these water cannons do is as we see the heat transfer changes within the boiler, we can target specific areas to knock slag down during operations. And so it knocks the slag off of the boiler tubes and keep that heat transfer. So it's efficiency of the boiler as well as the health of the boiler that's important for overall production.
Yeah, and this is part, Unit 1's going to happen during the 65-day outage, is that correct?
You know, we don't want to speak specifically about day outages.
Yeah, supposedly around that.
We're even close to
The,
that.
It's
the
a longer
spring,
outage.
the spring outage for NC1 and NC2, we will take on both of these projects.
Yeah.
So, Mary, since we're well under the engineered budget here, I asked the question yesterday about negotiating warranties and maybe maintenance contracts on this equipment.
Correct.
So, do
And-
you have any
and-
update on that?
And so the warranty is a one-year warranty. However, we are, as a part of a separate contract, we're identifying what spare parts we need. So they'll give us a spare parts list, as well as a maintenance contract, a 5-year maintenance contract with this. So it'll be a separate contract to address both those issues.
Good.
It'll be under, I'm sure, yeah.
Okay, thanks for your follow-up questions, Director Trinan. Anybody else?
That's the way to approach these things.
Okay, and back to Troy for the third action item that the board will see.
And so, over the last several months, we've had several items related to fiber optic ground wire, and this is another one of those. This focuses on the installation. And so, as a reminder, the project is to upgrade the communications that we have in place between our substations and our systems so that we can control those remotely. The telecommunications companies that had previously provided this service will no longer be supporting that, which is why we've gone down this endeavor to start with. So we've brought several items over the last few months on this. We are bringing it in segments, though, which is kind of unique, and that has to do with our engineering estimates. So as we do our engineering work on those and we go out for bid, we're doing them in segments because it is such a large project. And so, for instance, earlier in this year, the board approved for the fall of 18, 49 miles of line, which was around $1.4 million that was being performed by Watts. What we are doing now is asking for approval for the spring of 19, which is 110 miles for $2.6 million, which will be another entity. The plan would be to come back in June of next year for the final remaining 137 miles of fiber that needs to be strung. And so this is really on the contract labor. It includes the removal of the existing line and the hardware associated with that, the installation of the new fiber and hardware, and there's 10 transmission structures that will be replaced during that time period, as well as other small equipment. So when they're out in the field and they're loose bolts and nuts and cotter pins and things of that nature, as you have wind events, sometimes some of this material can kind of loosen up, so that they'll tighten that and take care of those type of items while they're out there also. There were 5 proposals were received. 4 were legally and technically responsive. Forbes Timberline has the lowest and best bid. And so what we're doing is asking the board to authorize us to award a labor contract to Forbes Timberline for the amount of $2.16 million and change for the procurement of construction services for the spring of 19 for ground wire installation and structure replacements.
Thank you.
Tim, do you have, who supervises? Do we have our own supervisors on site, or do we contract that work out?
Yes and yes. So we have some of our own folks that review the work that's being performed, and we also have some third parties that we use.
Okay, so you're comfortable that we're covering all the specifications? And,
Yep.
Okay.
Yeah, and we've had other experience with Timberline and feel pretty comfortable with the company.
Great, thanks.
This is really stuff that we really have to do. We have to get this completed by 2020, as Kate brought up before, as far as risk management.
That's correct.
Very important stuff.
It's a large project. We're going to see it again. We've seen it before, so thanks, and we'll appreciate the reminder when it comes back around. Any other questions? So thank you, VP Fisher and VP Vi. Appreciate it.
Okay, and we have governance now, and Ms. Timpson.
Yes, there's two things. I'll turn it over to Marvin. Severance agreement, and also next year's board meeting schedule is on the agenda. You can cover that. And then then we'll go to closed session to discuss some compensation issues.
Okay, so our first item is, as the board is aware, OPPD has been implementing an accountable management system, which includes reorganization of the various business units in the organization. We do offer a redeployment of talent program for exempt employees that don't meet suitability for a role criteria. We had one employee who has chosen to separate from OPPD as a result of the process and executed a separation agreement. Mr. Harvey worked as a product marketing specialist in our customer service area, Mr. Hardy, and chose to take a separation agreement. So that is reported. I do not offhand, do you?
30-some years.
Quite a long time, 30-some years.
So this will be in addition to his retirement, probably.
He is eligible for retirement, and I believe did take that option.
Okay.
Early retirement.
Okay, thanks.
Okay, and the next item is the board meeting schedule, which is posted for you in Diligent for 2019.
Which will be on the consent agenda,
Yeah.
unless it's
3
pulled.
p.m., 4 p.m.
And that would appear, all the meetings are scheduled as normal, the first Thursday after the 10th. There's no exceptions apparently to the.
I believe that's correct.
Like there was this year. Yeah, good question.
And it's nice that everything's at 4 p.m. I think everybody's happy with the 4 p.m. time now rather than the 10 a.m. time.
Yeah, I think that's been a good change. I was just gonna confirm that we're all comfortable. I know that
Yeah.
in years past, we've had one per year that's been at a different location in an evening. And I just assume that we're comfortable with
Well, it's worth,
sticking.
yeah, so I'm comfortable with that. I would be more comfortable, and I've stated the desire before, if we were to allow digital or virtual participation. You know, it's tough to come up here from Richardson or Pawnee County for a 3-minute presentation. And certainly, we've got people down there who are customers that deserve the same that we afford the same opportunity to, and, you know, don't put that administrative burden on them of the travel. So that's the only thing I would say could be better.
I agree with you. Do we have technology limitations? Are there legal limitations in terms of a public meeting in attendance, or what?
Cost limitations.
I think part of the conversation, that we've had internally, there may be some technology issues today that may be resolved in the future, but two is, we provide a variety of options for people to provide feedback on any board item that may come, or any item outside of that they can submit respectively to the board member, to the management team, that then we would share, and we do that in Director's Update if we get concerns or issues represented by a variety of different people. So it's not like we, don't take input or perspective or feedback or concerns or issues. I think the board sees those. So we felt there was still a reasonable opportunity for them to provide input and perspective, whether it's through OPPD listens, whether it's through the board contacts, whether it's through just the normal contacts that we get on issues or service-related issues that may generate through the emails that we may get, and I think we share those with the board. So we felt there was still great opportunity for people to be able to do that. I think there was concern on how you limit some of the capability on folks within our service territory on issues that would be within the OPPD's district. And so how do you restrict that? I reached out to a variety of different public power entities on that virtual. No one does that yet today.
Okay.
And part of the concern is that it would be outside their jurisdictional boundaries, that anybody in the world could jump in and provide that perspective. And is that the intent? And I think our perspective is we provided reasonable opportunity for people to give us input. So
I'd like to see you meet on Saturdays. I think Saturday at 2 o'clock allows all customers to come.
By a lame duck.
Yeah.
I was thinking Sunday at 7.
Sunday at 7.
AM or PM?
Both. It would be a two-part meeting.
We gotta make sure you get a cup.
I'm doing mass for the shut-ins at 7.
You know, previously, we did try to go, like to Blair or down to Syracuse or Scottsboro, those different areas, but it was costly, and I think now that we have it on,
Live streaming.
on streaming and everything, I think it's, people get to see that, and beforehand, I have much better contact with my customers now through, people sending me emails and that kind of stuff, and reading emails as far as to specific things too, so.
Also, I think Director Cavan and I were talking about districts election districts now. I mean, it never used to be that way, did it? So obviously, you're talking to these people who have a concern. They tell you the concern and you bring it to these board meetings or all of us do that. I think we do a pretty good job. Maybe that's just something we could improve on too, is how do you get out in your own district and keep your ear to the ground, as they say.
Next door
So they don't
neighbor.
have to come.
And this is
Anyway.
I'm a next door neighbor.
Yeah.
A lot of
But the turnouts usually weren't good, so.
Yeah, so let me just make two more last comments. I'll respond to you, Tim, by saying I fully agree that I think we've done a great job in the last several years of sort of opening the doors and being more transparent, and open, and like taking information in. I think we've done an exceptional job. I think we can continue to refine like anything else. I really think this is about like on Thursday when we're actually making decisions, is that a point at which we want to figure out if there's an opportunity, and I don't know the answer, to involve people. And I'm just looking at the board action items. Examples being corporate officer compensation adjustments, the decommissioning planning. We're not going to do anything today that's public that relates to those. I don't know that our customers would know anything about. I mean, we've talked a little bit about some decommissioning stuff. So my point is, when we get to Thursday, there's no information shared. And if I'm sitting down in southern Nebraska and I'm watching and I have a thought, I have a question, I have a comment, I don't have a mechanism by which to deliver that. And it's a ways to get in. So my only thought would be, let's be open to it. I
Sure.
don't have an answer
I don't
to
disagree
it.
with
But I don't think I think we should continue to think about ways to provide opportunities.
Yeah, I think the first threshold for us is we're not capable technology yet.
Sure,
So that's the first threshold.
Yep.
Then once you have that threshold resolved, then what are the kind of protocols you want to put in place?
Yeah,
So,
totally.
yep.
It's not
I gotcha.
simple, and I understand.
I got you.
Yep.
Or some of the reports that are not security sensitive or just their reports would be, instead of taking time here, and having this 5-hour meeting, and then we go to a 15-minute meeting on Thursday, we gotta come here anyway. Maybe some of those reports could be just, hey, here's what it is. You're not gonna get tons of public, okay, we got a generator that's being fixed or whatever. I mean, some of that stuff even could be done on Thursday. But that's always up to the chair.
Yep.
Whoever's chair decides these things. And, but good point. I agree with you now.
I'm just looking forward to spending Valentine's Day with all you people.
Is it Valentine's Day?
Yeah.
Did you guys put
Taking me to dinner.
Valentine's Day on it?
It is.
I get excuse you can get out of Valentine's Day.
No, never.
Sorry.
I think it should be a
All right,
sweetheart.
so then, there is one thing then on, there's Mo Dogman thing on Thursday.
We're going to do a little
Mo will be there.
recognition
Yeah, that'll be
of
nice.
Mohammed Dogman,
Yeah, that's on the agenda, I see, so that's.
a little
Okay.
resolution.
And with that, are we ready to go exec session?
Yeah, I think so.
All right. Okay, I move that the board go into closed session at this time, which is 11:25, to discuss corporate officer performance reviews and compensation matters relating to the reviews of Mary Fisher, Vice President, Energy Production and Nuclear Decommissioning, Mark Zedke, Vice President of Human Capital, Kate Brown, Vice President, Business Technology and Building Services, to discuss decommissioning planning details at Fort Calhoun Station. With respect to the 3 corporate officer performance reviews and compensation matters, a closed session is necessary to prevent needless injury to the reputation of the individuals involved, and neither corporate officer has requested a public meeting. With respect to the Fort Calhoun decommissioning planning, this closed session is necessary to evaluate legal and regulatory matters that are protected by the attorney-client privilege, and to evaluate competitively sensitive decommissioning planning details that would create a competitive disadvantage to the district if known by potential vendors for decommissioning work.
Okay, Tim, before
add
we
one?
go on, could we?
What's that?
Can we amend the motion, I guess, to include the review and compensation related matters for Javier as well?
Yeah, absolutely. So then I would amend that to add Javier Fernandez for the performance evaluation.
Does he have to reread the whole thing? Steve, are we okay?
Steve?
I think we're good.
Yeah, the question is, does he have to read the whole thing back over again, or can?
No, I don't think you
Just
need to
add
read the
that
whole thing
amendment.
back over, but the second needs to agree with the amendment.
It hadn't been made yet.
second.
Oh,
Yeah.
Yeah.
Amendment.
I second the motion.
There you go.
Thank you.
With the amendment.
Okay. Barrett,
Yes.
Kavanaugh,
Yes.
Gay,
Yes.
McGuire. Yes. Mine's Moody,
Yes.
Trinan.
Yes.
Yoder. Yes. Thanks. Motion carried.
The motion and amendment to go to closed session has passed. The closed session will be limited to four corporate officer performance reviews and compensation matters and the discussion of competitively sensitive decommissioning planning at Fort Calhoun Station. No votes or board action will be taken during the closed session. Okay.